and welcome to Innowave 20. So join me as I go right in to get this conclave kick-started. Hello and welcome to Innowave 2023, an ETF conclave by Mirae Asset India. It's a very, very specially curated event that Mirae Asset India has put together to promote ETFs and to also bring together collaborative minds from the world of finance and investing. So join me as I go right in to get this conclave kick-started.
Don't hear any answers. Yes, no, maybe. Are we set? All right, great. My name is Karunya Rao and I will be your host for the evening. And let me extend a very warm welcome to all of you ladies and gentlemen present in the room to Innowave 2023. Let's get started with a round of applause, shall we? Okay, so let me set the agenda right. We've all gathered here today to talk about ETF investing. And why now? I mean, why are we talking about ETFs specifically? ETFs has been one of the hottest topics that we've been talking about when it comes to investing, especially here in India. Let me read out some numbers for you. As of 30th September 2023, the global ETF industry had 11,627 products with 23,560 listings, assets of $10.3 trillion. 710 providers, 80 exchanges across 63 countries. These are the kind of astounding numbers that we're talking about. And clearly, this merits a discussion, right? And that's exactly why we're here for today. Let's bring on board the man whose vision is behind all of this, behind translating, our thoughts, these discussions, the rising trend of ETF investing in India. Mr. Swaroop Mohanty, he is the Vice Chairman and CEO of Mirae Asset Investment Managers India. He is here to set the tone right and to tell us what exactly to expect from Innowave 2023. Please come on stage.
Good afternoon, everybody. Karunya, thank you for starting it off. It's my absolute pleasure on behalf of Mirae Asset to welcome all of you in the third edition of Innowave as we speak, a thought which started 4 years ago, was somewhere stunted because COVID started, but we thought we'll do it the online way. That was the first time we did it, and we met here last year to do the second edition, and we are back with the third edition. A big thank you to all the speakers who've agreed to take the stage for us today. It's an absolute honor and pleasure to have you with us. A bigger thank you to Evan, who's flown all the way from Australia to be here, and he will share his views of what the Australian ETF market looks like. So when you sort of are given the opportunity of kicking off this whole session, what I thought I would do is, before the stalwarts take the stage, I'll just try to give you my thoughts on how it looks to be setting up, because all of us will agree that this is practically the inception stage of passives as it gets built in India. I have been so far an active seller, now beginning to understand what passives is in the last 4 or 5 years. And can we start the presentation, please? Yeah. Trying to understand passives for the last 4 years, and it's been an incredibly learning experience. I think the first experience that came to me was running the active business is very passive, but running the passive business is extremely active. And you have to be on your toes 24/7 during market hours. It is business in a very focused manner. And that was the first shock that I got, that, it is so intense to run the business at the back end, is a phenomenal learning. Yesterday, I was told about how we've started doing stock lending at our side, and I was requesting my team members, why didn't you start it till I ended my career? Because now I have to start learning what stock lending is and start talking about stock lending. But that's the beauty of the asset management business. From our perspective, let me make things very clear. Whenever an active manager stands up and starts talking about passives, it is perceived that, it is this versus that. I completely disagree with that, because these are two different parts of the same business. While many of us in the past have followed Mr. Warren Buffett, and I say this with a lot of humility, on the day after Mr. Munger, but there is a John Bogle side of the story also. And it's fascinating how both these gentlemen talk about the same underlying in a phenomenally different manner, and both are absolutely correct. So this fascinating journey of my personal experience of moving from Warren Buffett to John Bogle and trying to merge both of them is something which I see unfolding in India in the next 5-10 years. Some of the data points as we speak are pretty interesting, because when you look at the broad industry, this is where it stands. Look at the industry at the inception stage, and I'd like to try and bring some parallels to the active industry when I started selling funds in the late 90s. Broadly, there is a general thought, but the data sort of speaks a little differently, because the difference in the number of products between index and ETFs, we have the ETFs at 187 and the index at 191. You will see it unfolding probably in a very different manner in the next 8-10 years. From AUM perspective, contrary to what people believe and practice, these stories very different. 76% of assets under management are in the ETF side, and 24% are in the index side. The number of folios, again contrastingly to normal belief on the ground, 75% of investor folios are on the ETF side, and 25% of the folios of the passive industry in India are on the index side. And this is data, and data does not lie. When you look at the growth of the industry, it's even more interesting, because till now when we discuss passives, it is perceived to be mostly government-backed money and investors at the bottom line not participating in a big way is what is the general thought. But when you look at the industry penetration, what was just about 2.5% of the industry folios in as near as 2019, today is 14.5% of industry folios. The incremental growth in folios just signifies the growing interest of the products and the beginning of the penetration of passives in this industry. In just 5 years, it has now come up to 15% of the industry at a retail investor or at an individual investor participation perspective. Yes, the AUMs one can debate because a lot of that AUM comes from the government sources. But at this moment, 16.5% of the AUM is passives as we speak, which was just 6.5% 5 years ago. Just to take this story as one step forward, if you see the incremental growth, yes, one can debate that the base is a little low, but when you see the incremental growth, the orange line is the passive growth and the blue line is the active growth. Incrementally, and probably from 2019, we saw the advent of the government money both on the debt and equity side, so we've seen some huge towers there. But year on year, the growth of passives is incrementally higher on a percentage basis on the active business already. From an ETF perspective, what was just 43 products in 2014 now is 187 products, and this is what fascinates me. And let's put one thing very clearly in our minds. Today, when you look at the active industry, there is the categorization of funds. So when you look at categorization of funds, it's already laid out. That is the number of products that we can give to you, and the basic construct of that product is already laid down by the regulator. But on the passive side, wherever there is an investable universe, you can create an index, and through factors, you can give multiple forms of the index. So ideation is unlimited on the passive side, and hence you see the growth of the industry on different products. Now, my personal belief is when you look at the active side of the business, one will now, because of categorization of funds, one will look at differentiation in fund management style. That is what you can expect from us. But if you need differentiation of products, invariably it has to come from the passive side, and that's where the opportunity is going forward. Right? You will see an extraordinary form of products coming on our side, and Evan, don't underestimate the Indian acumen on building some phenomenal products in the next 5-10 years. I would really request you to watch our space on product ideation as the industry unfolds. To take this one step forward, and that's something which is even more interesting to me, because at an inception level, it is very important to see how we as manufacturers behave and how you as advisors, distributors, or investors are behaving. And these are two different slides. The first one, of course, speaks of us as manufacturers on the ETF production side. 56% of our products are the core side of our business, which is broad market cap indices. 26% is smart beta, contrary to what we believe that, more and more products are being built on smart beta. Maybe the 5-10 years later, we'll see that. We have around 38% of our products coming on the debt side. The simple point I'm making is the product basket is looking nice and diversified and not skewed in any manner or biased towards any particular category or assets as we speak. It is very evenly sort of divided, making the point that the manufacturers probably have learned or matured over their learning in the active side and are approaching this business in a very different way. That's one way. The other part is when you see the passive side, investor mix, 65% of the money is in the core products. Unlike what we are seeing in the active side in the last 2 years in particular, where nearly 40% of the money is chasing returns in the form of small caps, that is not so on the passive side. There seems to be a very nicely, evenly balanced AUM on the passive side. Please remember, when you look at the financial assets of India or the Indian investor, and this is the RBI code 2021 data that I'm quoting, is that nearly 55% of the individual data or money is in banks in the form of FDs or savings banks. Another 13% is in cash. So 68% of a person's money is in safe assets. When you contrast that to this, I think the risk profile is more or less matching. And there I see a lot of maturity in the way the investors are behaving so far. It'll be interesting to see how this unfolds. There are 70,000 corporates already participating in this industry, 70,000 in the ETF side. This is the demat account. Sorry, I'll come to that in the next slide. We've seen a demat boom. Correspondingly, we've seen a non-corporate folio increase. I dare say the increase from our side could have been far bigger. People are finding stock broking to be more attractive than ETFs or passives. But I'll watch this space in the next 4 or 5 years. And this is the slide I was talking about. Nearly 70,500 corporates have already started trading in ETFs in India. That's not a small number. Out of 2.5 crores or 2.3 crores, 70,000 are corporates in India already. So it's not just the individuals or the government money coming. Slowly we are seeing the penetration into the corporate side as well. The increase in the trading volumes just signifies, and we'll see some amount of it, some talk of it in the later sessions, is that we are beginning to see the formation of the capital market side falling into place. The volumes are consistently growing. A lot of it is now looking like organic volumes as we speak. The bulk of it is in the pure market cap indices, and that's what happens at the beginning of the industry. But slowly but surely we are seeing volumes picking up. And again, I'll request all of you to watch this space in the next 5-10 years. I will definitely stick my neck out on dramatic increase of this slide in the next 5 years, or probably next time when we do our conference. And just, I'm sorry, I'm just using our products, but just to prove a point that even on the passive side, there are products across the risk spectrum. We have the liquid ETF doing a great entry into the industry, and on a daily basis, the volumes seem to be growing, and we go up to International FANG Plus as we speak on the riskier side. Slowly but surely, you will see this completely filled up, and the industry coming back to you and giving you products suiting your risk profile across the risk spectrum in the next 4 or 5 years at least, and that will happen quicker than we think. Just one selfish slide from our side before we end, and then to talk about how we approach this business. Our view is very simple. We are a market, we are an asset manager, we are product developers. We are not in the business of advising customers. Our business is to produce a good product, and we are, what can I say, absolutely away from that bias of whether it should be active or passive. Our job is to give you good products on both sides. Your job is to choose what is right for the investor. That is the stand that we take at Mirae Asset. So when we look at approaching the passive, it's as good as whether we should launch a small cap fund or we should launch a small cap index. We view that both very, very non-emotionally. If you see, we run a good mid-cap side of our business. We have also probably one of the cheapest mid-cap indices or ETFs in the market. And that's the great part of working in Mirae Asset. We look at the merit of each product as we develop. But through solutions, we believe the future can happen, and a lot of asset gathering will happen through solutions, and that's where we'll place ourselves going forward. We do believe globally, and I think Evan will speak about it a little bit more, we are market disruptors in the form of themes. Thematic investing is yet to take off in a big way in India as such, but the next 5-10 years in the search of alpha or that extra return on your satellite part of the portfolio, themes will begin to play out. We are, of course, fairly competent on the cost in the market. We do come to the table with our own market maker, and hence we believe our liquidity and spreads are fairly competitive in the market, and we are capable of doing customized executions for all clients in this market. Of course, we will back it up with ideation. The future for Mirae Asset will depend on our ability to give you innovative and good products, and I will back my team on that. And I said, don't underestimate not only ours, but the industry's capability of giving you some phenomenal products on the passive side in the next 5-10 years. So just to sort of sum up, it's an absolute pleasure to see all of you gathered today. And we get into the 3rd year of this. I hope and pray that we can extend it perpetually and let this be a place where we just get together and understand passives and ETFs in a better way. Thank you so much for coming, and really appreciate your patience listening. Karuna, it's back to you.
Swaroop, you've left your spectacles. Okay, thank you so much for laying down the agenda for us so vividly and in such an interesting way. ETFs clearly have come a long way in India, and the AUM of India ETF stands at almost 5.8 lakh crore as of last month, as of 31st of October 2023, registering a 44% on an annualized basis compared to 5 years ago. In the last 3 years, if we look at September end numbers of 2023, the folio count of retail investors in India has increased from 35 lakhs to a whopping 1.7 crore. What is shaping the landscape within the ETF space in India? Where are we headed? To give us a peek into the activeness in passiveness, let me call upon our next speaker of the day. Mr. Mukesh Agarwal, he's the CEO of NSE Indices. Let's put our hands together and welcome him on stage.
Just change this. Uploaded, I can. Yep. Good evening, everyone. And before I proceed, I would like to thank Mirae for giving me this opportunity to make this presentation. And I think Swaroop has already spoken. I think must have already given some of those data points. There could be a repeat, but let me see how I can bring in a different twist to the whole thing. Now, we at NSE Indices and at NSE, we are really very excited with the kind of growth which we are seeing in the ETF industry. I would say ETF plus index funds also. We look at passive as a whole because there is reason why ETFs and index funds both are growing. So because if you look at the first ETF in the Indian industry, in the Indian markets, was launched somewhere in January 2001. But for I think around for almost 14, 15 years, there was hardly any growth. The AUM, if I remember correctly, at the end of March 2015, was about 8,000 crores only. So launched in 2001, AUM in 2015, almost 15 years, 8,000 crores. But after that, we have seen a spectacular growth. Numbers talk about it. I will also share some numbers. So we have seen a phenomenal growth. And one of the key reasons was why the industry has grown. There are, I would say, 2-3 reasons. One is Government of India, they decided to disinvest through the route of ETFs. I'm sure a lot of us would have heard CPSE ETF, that is one. Then they did with Bharat 22 ETF. And also the big game changer in 2015 was EPFO deciding to invest in the equity markets. EPFO is the Employees Provident Fund Organization. They decided to invest in the ETF markets, also in the equity markets through the ETF route. I think the first investment they made was in August 2015. And that was the inflection point. After that, the industry has been growing, I would say, exponentially. So in the first slide, I will just talk about the comparison, a brief comparison of the Indian industry with the global industry. So if you look at the global side, the global AUM is around 10 trillion. And if you look at, that is 10 trillion US dollars. If you look at the Indian industry, this numbers, what I'm talking about is the total passive. I think total passive, which includes ETFs plus index funds. The total size is around rupees 7.63 lakh crores, 7.63 lakh crores. And in dollar terms, for even it would be around $95 billion. That is the size of the passive. And the growth, if you look at globally, the annualized growth over the last 10 years has been around 15 odd %. Year after year, for last 10 years, they've been growing at 15%. If you look at India, in last 10 years, the industry has grown at an annualized rate of 52%. So that is the kind of growth we have seen, and most of the growth has come in the last 7-8 years. Now, if you compare the mix, global versus India, globally, if you look at the composition of $10 trillion is approximately 72% equity, 18% fixed income, and 10% commodity and others. If you look at in India, 70% is equity, so equity is more or less the same, 72 versus 70. But if you look at fixed income or debt is about 26%. So in India, we have a higher composition of debt passive, and that is mainly the reason because of the launch of target maturity funds, which the first product was launched in December 2019. We as a index company, we take a lot of pride that we created that product and we launched that index, first index to be launched in India. And after that, we have seen an explosion in the debt passive also. I'll share some numbers. And commodity is very small, about 4%. As compared to globally, it is around 10%. Now globally, if you look at the geographical breakup of the AUM, 70% is US, 16% is Europe, 11% is Asia Pacific, and 3% is others. Now, in India, if you look at only the AUM of equity passive, Sharoop had shared that overall passive as a percentage of industry, mutual fund industry AUM of 46.71 lakh crores is approximately 16.5%. But if only look at equity passive as a percentage of total equity AUM of the mutual funds, it is about 22%. That is quite a higher number. And that most of the growth has come in the last 4 or 5 years. Now, globally, I think already people have said there are 11,000 plus products. In India, if you look at it, there are 378 products, out of which 22 are commodity ETFs, that is the gold and silver. And there are balanced 356 are debt and equity products. I think that is the breakup we have. Now, annualized net inflow in the current financial year in the global markets, that is from January to October 2023, inflows have been around $662 billion US. If you compare the Indian markets in FY23, that is financial year 23, April 22 to March 23, inflows were about 1.55 lakh crores. That is in terms of dollars. If you look at even, it would be around $19 billion. In 12 months, we did that. And in the current financial year, in the first 7 months, the inflows have been around 33,000 crores. That is the kind of inflows we are seeing. Now, this is an interesting slide. This just shows how the mix has been changing. Initially, if you look at 2017 and 18, about 95% was equity and almost 4-5% was debt. But now, if you look at as at October end, 76% is equity plus, this is a passive equity, and 24% is debt. So that is the kind of numbers we are seeing. The debt has become significant, with almost being negligible. It accounts for almost 24% of the industry AUM. Now, in terms of growth, I've already said that industry has grown for more than 50% per year over the last, from March 17 to October 23. Now, in terms of number of products have grown 4.5 times from 84 in March 17 to about 378 in October 23. And within that, if you look at the ETFs have grown from 49,000 crores to 5.79 lakh crores in October, from 45,000 crores in 17 to 5.79 lakh crores. But if you look at the index funds were, AUM was only 2,000 crores in March 17, 2,000 crores to, it has grown to 1.84 lakh crores in October 2023. So that is the kind of growth which we are seeing. This chart shows that if you look at here onwards, I will only talk about passive, debt and equity passive. I am excluding the commodities, which is the gold and silver. The AUM is around 29,000 odd crores. So I'll be talking only about debt and equity. So if you exclude gold, the total AUM of equity and debt is around 7.34 lakh crores. And out of which total passive, 73% is equity and 27% is debt. But if you look at the breakup in ETFs versus index funds, in ETFs, equity accounts for 84% and debt is only 16%. Whereas if you look at it, index funds, equity is only 40% and debt is approximately 60%. Debt again is very high because of target maturity funds, which is one product which has really picked up significantly after the first product was launched in December 2019, after Bharat Bond ETFs were launched, and because of which in index funds, because most of the target maturity funds initially it started with ETFs, but I think gradually everyone launched, after I think 4 or 5 months, everyone launched only in the form of index funds. So all the target maturity funds now, whatever have been launched in the last 2 years have been in the form of index funds. Now, if you look at in terms of number of passive funds, for the entire industry, passive industry, debt and equity industry, total number of funds is 356, out of which 247 products or 69% of the products are in equity and 31 products, that is 109, is in debt. But if you look at ETFs and index funds, in ETFs, only 15% number of products are in debt, wherein if you look at it on the index funds, approximately 45% of the products are on the debt side. So basically, index funds, more debt products are being launched or that are more popular over there. So this slide talks about basically who are the major index players and what are the market share. Because being from NSE indices, I have to talk about myself and how we fare in the industry as a whole. So if you look at the AUM of equity AUM is around 5.33 lakh crores. Within that, 3.7 lakh crores is benchmarked to Nifty indices. That is approximately 69 to 70% of equity passive AUM is benchmarked to Nifty indices, that is NSE indices. And within that, if you look at Nifty 50 itself, Nifty 50 is the most popular index in terms of number of products available. I'll show the subsequent slide, number of products available. That accounts for almost 50% of the equity passive AUM. So about 2.7 lakh crores out of 5.33 lakh crores of equity AUM is linked to Nifty 50. It is the single most popular index in terms of equity AUM, equity passive AUM. So overall, if you look at in terms of AUM, 72% of the assets is linked to the Nifty indices. If you look at in terms of number of products, 75% of the products are linked to Nifty indices. The story remains the same in debt also. Debt total AUM, debt passive AUM is around 2.01 lakh crores, and approximately 82% of the AUM on the debt side is linked to Nifty indices. And there also one particular index, like I spoke about Nifty 50. Here we have a Bharat Bond Index series, about 59,000 crores of AUM in the debt side out of 2 lakh crores is linked to Bharat Bond Index series. I think that is the most popular. This slide, I think Swaroop has already spoken about. Just highlight is 16.3% of the passive AUM passive accounts for 16.3% of the total industry, mutual fund industry AUM. And on the right-hand side, I've given the global numbers also, and globally that number is around 15.7. So in India, passive as a percentage of total mutual fund industry AUM is slightly higher or marginally higher than the same number what we see globally. And if you look at only equity passive, I have mentioned this earlier, equity passive accounts for 22% of the equity AUM of the mutual fund industry in India. So this is again the slide which shows about yearly inflows. So I have two slides. One, I will give the yearly inflows on ETF, how the inflows have been taking place in ETFs, also the number of folios created. So if you look at the inflows have been growing significantly higher in FY 21-22, almost 82,000 crores. Last year it came down to 60,000 crores. And first 7 months, that is April to October 23, the AUM inflows have been around 24,000 crores. And if you look at the right side column, it gives the number of new folios being created for the ETF side. So ETF, if you look at as on October end, we had folios around 1.26 lakh crores. Out of which 1 crore folios have been created in the last 4 years. Basically starting from FY 2021, wherein 23.6 lakh folios were created, 21-22, 63 lakh folios were created, FY 22-23. Last 2 years, we have seen some slowdown in the number of folios being created in ETF side. But if you look at the index passive, Yeah, index passive, the story is different. As I said, the total index funds AUM is around 1.84 lakh crores. And if you look at the numbers, at 21, 22, 22, 23, almost 1,40,000 crores came into the index funds in these 2 financial years. So out of 1.84 lakh crores of AUM of index funds in India, 1.4 lakh crore of inflows happened in 2 financial years, which is in FY21 and 22-23. I think that is the kind of flows we have seen. There has been some slowdown in the current financial year. Current financial year, first 7 months, the inflows have been only around 6,000 crores. But if you look on the right-hand side, last 3 financial years, around 46 lakh folios have been created. Total folios on the index funds is around 57 lakh folios, out of which 46 lakh folios have been created. In my previous slide, I had given the numbers on ETFs. ETFs, we had seen a decreasing trend in number of folios created. Basically, I think this is the slide. So basically from 62.9 in 21-22, it went down to 15.2 in 22-23 and 5.6 in 23-24. But if you look at on the index funds, the number of folios created are still increasing. So we had 14.54 folios created in 21-22, 13.84 folios created in 22-23. And if you look at the first 7 months, 18.3 lakh folios have been created. So what we are seeing that probably this gives a hint that many new retail investors are coming in the passive through the index funds now. So I think this is another interesting slide which talks about, I will give two slides, one on in ETFs, which are the top 10 indices on AUM wise. So if you look at most popular is Nifty. So top 10 indices account for 90% of the ETF AUM. So again, repeat myself, top 10 indices, the list of indices is given over here. They account, the AUM of those top 10 indices is around 90% of the total ETF AUM. The biggest being Nifty 50. Nifty 50, we have around 17 ETFs. The AUM is around 2.32 lakh crores, and it accounts for 40% of the ETF AUM. And on the debt side, the second largest is Sensex. Sensex is around 12 products, 1.34 lakh crores. The third one is Bharat Bond Index Series, which I just mentioned earlier. There are 5 products over there, and the AUM is around 59,000 crores. That is the kind of number. But if you look at the, so another thing you will see that in the top 10 indices, 7 are equity indices and 3 are debt indices. One is Bharat Bond. The second one is Nifty one-day rate index, which is the money market ETFs, which Swaroop talked about. And the third one is Nifty SDL April 2026 top 20 equal weight index. Now, if you go to the so this slide talks about the top 10 index-wise index index funds in India. So if you look at the top 10, here the story is very different. And out of the top 10 indices, 7 are debt indices and 3 are equity. In the ETF side, we saw that in top 10 indices, 7 were equity and 3 were debt. But in the index fund, the story is totally reversed. So it's only 3 equity indices and 7 debt indices. Here also, the largest index continues to be Nifty 50, which is about 18 products and has 39,000 crores of AUM chasing it. So top 10 indices in ETFs, we saw that they account for 90% of the AUM. But if you look at in the index funds, top 10 indices account for 63% of the AUM. And here, in the top 10, we have 7 debt and 3 equity. And Nifty 50 continues to be the largest. It accounts for 21% of the index funds AUM. So I think Swaroop did talk about the variety of indices, or he had mentioned category-wise. He had said broad-based indices account for this percentage, this category account for this much. But here, this slide shows you the actual list of indices on which we have equity products. So today, if you look at equity ETFs and equity index funds, we have totally 247 products. And we have these 247 products available on 68 unique different indices. I think that is the key message I want to leave over here. So again, Nifty 50 continues to be the largest, 35 products, 2.7 lakh crores of AUM. But also, all of us as an investor, we have a full bouquet of indices on which products are available. So we have products available on Nifty 50, we have products available on Next 50, we have product available on Nifty 100, Mid Cap 150, Small Cap 250, Nifty 500. In fact, we also have ETFs on Nifty micro segments, all market. Good thing is now also we have products available on various factor indices, factor or strategy indices. Like we have a product available on momentum, we have products available on volatility. If you want to take exposure to passive through sectoral funds, we have products available on Nifty Bank. Nifty Bank is very popular again, but we also, like bank comprises of only top 12 banks. But if someone wants to take an exposure to financial services, we have Mirae has a product on Nifty Financial Services, which comprises of banks plus financial services company like NBFCs, insurance companies and other companies. So we have products on that. If you look at it on pharma, we have products available on Nifty Pharma. And other than that, pharma index comprises only of pharma companies, but we also have products available on Nifty Healthcare. So Nifty Healthcare comprises of pharma plus other companies in the healthcare services like hospitals and testings and all those kind of stuff. So we have a wide range of indices on which products are available. I think I would say investors are spoiled for choice. They have to decide which sector, which strategy they want to invest in, and they have a product readily available. So that is what it is, 68 unique products on which, 68 unique indices on which products are available. Here I will not spend much time because Swaroop has already spoken about it. So basically average daily trading volume in the current financial year is around 593 crores per day. It used to be around 137 crores in FY18. But FY18, if you look at the trading volumes, 137 crores, most of the trading volume used to be in the money market ETF. That time also we had some money market ETFs available. And out of 137, I would say 90% was because of money market ETFs. But now in the current financial year, out of 593, money market ETFs is only 220 crores of trading volume. And rest is accounted for debt and equity. So trading volumes in debt and equity ETFs also has been going up. And another interesting fact which I want to share with you all, so at least whatever data we observed for last year, 1 out of every 3 retail investors who traded on NSE platform traded in ETF. So I think that is the kind of interest we are seeing from retail investors. No, I think we believe that what are the growth drivers? Growth drivers, one is definitely increasing awareness amongst retail investors, reducing alpha between active and passive funds, and pension funds investing in ETFs or investing in equity through passive, which is again a big driver of growth driver. Then increasing popularity of debt ETFs. For the time being, debt ETFs or index funds have taken a backseat, but I'm sure going forward they will again come back strongly. And significantly lower expense ratios, and market makers will play an important role in improving liquidity. And launch of passive and new concept. I think that will again be another growth driver going forward. We are already seeing that because we as index providers, we are flooded with requests. Create an index, XYZ index, create this. Most of the products or new indices which we have launched in last 2-3 years, I would say that all the products, all the indices we have launched have been based on the requests given by the various mutual funds. So earlier I would see that 5 years back, if we launch an index, we would have to go to the mutual fund and tell them, so and so is a new index which we have launched, please launch a product on it. But now the scenario has totally changed. Last 2-3 years kind of products which have been launched, and we are seeing the demand coming in from the mutual fund industry, mutual fund players. They come to us with an idea, then we jointly work with them, create an index, we do a back testing, see how the results are, and based on that, then we launch the index. In fact, another thing is, out of 378 products what we have outstanding today, about 221 or 230 products have been launched in last 2.5 years. So most of the new products have been launched in last 2.5 years. I think that's all from my side. Thank you very much.
We request you to stay on stage for a minute. Swaroop would like to felicitate you and give you a small token of thanks. Okay, so we've been talking about the growing trend of ETFs in India, but not just in India, but the uptick in passive investing has also been gathering steam in Australia. Our next guest speaker today has come all the way from down under to help us understand the evolution of passive landscape in Australia, how in many ways it mirrors what's happening here in India, and what are the stark differences. Please allow me to welcome our next guest, Mr. Evan Metcalf, the CEO of Global X Australia.
Good evening, everyone. Thank you very much. I think first of all, just to say a big thank you to the Mirae Asset India team for organising such a fantastic event. It's great to see so many people here. I don't really want to think about how many people are watching online. That sounds slightly scary, but it's a real pleasure to be here and to speak to you all tonight and to share a little bit of my experience about how the Australian market's evolved, and I think there's some interesting parallels that we can draw between what's been happening with passive investing and ETFs in Australia and the current situation in India. So this is my first time in this fabulous country. It's amazing to be here and also to hear a lot of the enthusiasm around asset management, around passive and around ETFs, and there seems to be a lot of excitement and a lot of momentum building across the industry here as well. Number one rule, I was told, don't mention the cricket. So I thought the hospitality and everything that I've received from Swarup and the team here and everyone that I've met so far has been amazing, so I promise I will not mention the cricket. So that's out of the way early. But yes, it's a real pleasure to be here. So, sorry, just, there we go. I guess one thing we probably didn't, initially just a bit of an introduction to Global X to start. So I head up the Global X business in Australia, but we're part of the Mirae network, have been part of Mirae Asset for just over 18 months. But really, Mirae as an ETF business is a global business. So we have well over $100 billion of assets across all the key markets in the world, across the ETF industry. So across the US, across Europe, Latin America, much of Asia Pac, and of course with the Mirae team here in India as well. So ETFs are a big focus of Mirae Asset, and similarly, in the same way that India is a massive strategic market for Mirae Asset, Australia as well is one of the key markets that Mirae has decided to invest in. And that's put a lot of impetus in our business and seen a lot of development in what we've been able to bring to the Australian investing community. So to give you a little bit of a flavour about what we do, and you might see some differences between the offering that we have here and some of the things we saw from the last presentation around the Indian market. But so we currently have 35 ETFs in the market, around 6 billion Australian dollars. So that's about $4 billion US dollars. Apologies, no lakhs or crores in this presentation. I'm not quite too sure what they are, but I think I'll work it out. And the focus of our product range, from a historic sense, has been commodities. So in 2003, our business launched the world's first physical gold ETF. So that's still actually our flagship product, and a large percentage of the assets that we have under management as a business. More recently, thematic investing. So we were one of the early pioneers in Australia with thematic investing, bringing our first product, a robotics product, to market in 2017. So that's been a real area of focus for us and a big differentiator of our product set from a lot of our competitors. There's a couple of other really interesting areas that maybe haven't quite hit the Indian market yet, but one area that we see a lot of activity in is leveraged and inverse funds. So we run, as you can see on the far right there, leveraged and inverse funds over the NASDAQ 100. That's a really an area that has seen a lot of take-up from sophisticated investors over the last probably 2 years or so, particularly around some of that COVID time where there was a lot of trading opportunities. And I think the other thing just to call out is that we actually have in our product lineup the only spot Bitcoin and Ethereum ETFs across the entire Asia-Pac region. So that's been a real big challenge bringing those to market. We've had those on the shelf for about 18 months or so. It's been a pretty interesting time in crypto markets, but there's a bit of momentum there at the moment that's giving us some interesting times in Australia at the moment. So I think there's some more exciting things to come ahead in that market. Okay, so looking at the global ETF landscape, I think we may have coordinated slightly better on this one. I think I might be the fourth person this evening to tell you that global ETF assets are currently sitting at around $10 trillion. So I won't dwell on this for too long, but yeah, there are around 12,000 ETFs in the market, which is pretty astounding if you look at that as a growth over a 20-year period. But I think the interesting thing from my perspective there, which might not seem very significant there, but you can see on top of the orange bars, there's some small blue bars, and that's actually the Australian ETF market. So just to give you a bit of a global context. So we're currently sitting at about 1% of global ETF assets, which doesn't sound very flattering, but it'll give you a little bit of a context as to where we see the growth opportunity there as well. So you can see that a little bit more clearly on the next chart. So in terms of the global breakdown of ETF assets under management, so the US dominates. Around 70% of the ETF market is US-centric. Europe is the second biggest market at around 15%. And then Asia-Pac makes up the majority of the rest, along with Canada. And you can see Australia there in the orange at around 1%. In terms of the split of asset classes, ETFs are still very much an equity-dominated market, with around about 80% of ETF assets in equity-dominated funds or in equity-linked funds. Fixed income, however, very much the topic of the day and very much the growing asset class, and we see that in a similar way across the Australian market as well. Okay, so I mentioned some parallels between the development of ETFs in India and Australia. So I'll give you a little bit of a historical background on the Australian market to set the scene. So the first ETF, as with India, the first ETF in Australia was launched in 2001. So State Street were the initial issuer there. They brought to market an ASX 200, so that's our benchmark index ETF, and a few other funds. But really at that point, ETFs were very much unknown. You had some early adopters in terms of retail clients, very few advisors, but there were some involved in the early days. But you can see growth levels were not particularly astounding. So even fast forward to 2010, the market was pretty small. From 2003, we had a gold product in the market, but that didn't take off in a massive way either until much later. So a lot of the impetus in the market started around 2007 to 2009 when you saw some of the other big US players coming into the market. So we have Vanguard and BlackRock both entered the market in that period. And that's where things started to move, started to get a bit of traction. So between those two managers, they're still around about 50% of the entire market. So the big boys very much dominate the market, but there's a growing cohort. So across all the entire market now, we have around 48 issuers, including both passive and active ETF issuers. So I'll come back to that side a little bit later on. Fast forward to the period between 2013 and 2017, and that really set the scene for the growth to come. So again, I'll come back to this in a little bit more detail, but the real interesting things that happened in that period were around reforms to the financial system and things like removing some of the trailing commissions and things that incentivized advisors in particular to use active funds over passive in the past. And then you can see the growth really started to pick up. So 2018, the industry hit $50 billion. So that was 17 years after the first ETF came to market. And then the next 100 billion has come in about 4.5 years after that. So at the moment, we're sitting at around 150 billion Aussie dollars. And there's pushing 350 ETFs in the market. So there's been a massive pickup across all channels over the last sort of 5 or so years, and COVID was a big driver of that as well. So asset breakdown for our industry in particular, a little bit different to the global setup, but it's still quite an equity-dominated market. I think the interesting thing to note there is that actually international equity, this is very much in contrast to the Indian market, international equity is a bigger segment than domestic equity. So that happened a couple of years ago. Initially, the largest funds were domestic broad-based ETFs, but that's actually switched over about 3 or 4 years ago. And so you can see the way that people are using ETFs to really get access to international markets is a big plus, particularly given our time zone in Australia, where we're very much the other side of the world from a lot of the major markets. That's really interesting to see how people are using ETFs in that regard. Sorry, thank you. And the other key area to point out there, fixed income as well. So that's been definitely the biggest area of growth in 2023, both on the domestic side, but also on the international side as well, with people looking to play, in particular, US interest rates. That around about 15% of the ETF market in Australia is active management today. So while we think about ETFs as generally being passive vehicles, it's very much just if you think about it in reality, that's almost a quirk of history. ETFs are effectively just a wrapper. Whether it's active or passive is something that will probably dissipate over time. So we've had active ETFs since 2015, and we've got quite a big build-up in momentum of active issuers coming into the market to try and, I guess, use those common themes around ETFs of ease of access and ability to trade on exchange during the trading day, and to bring that into their business model as well. So that's one of the interesting trends that may come to India at some point in the future. And I think also it's worth giving just a little bit of context of the overall investing landscape in Australia, just so you can sort of see where ETFs fit. So this gives you a picture of what are the investable assets in Australia. So the main pool of assets is our pension funds, so superannuation. So we've had a compulsory superannuation scheme since the 1980s, where every employer has to put, at the moment, 11% of every employee's salary into compulsory pension savings. And so that's given us a massive pot of about $3.5 to $4 trillion worth of pension assets. And these aren't, I'll come back to the way these are being deployed in a minute, but generally, this segment isn't a big user of ETFs, but that's something that we're looking to change. So you can see everything else is relatively small. ETFs represent about 5% of the overall investable universe. And so again, that gives you an idea of the sort of opportunity there is as the take-up of ETFs continues and gets bigger and bigger, that there's a large runway of upside available to the industry. So looking further ahead, I've identified what I think are the 4 real key trends that we're seeing in the market at the moment that are likely to continue into 2024 and really beyond that as well. So the first one is the shifting market in financial advice, and so how advisors are using, or what sort of products advisors are using, and how they're getting more and more involved in the ETF market. Second one is active versus passive. I touched on the active ETF growth, and we'll come back to that a little bit as well. The third one, cost is key, and I've put a little but there as well, so I'll give you a bit more context on that. And then the fourth one, product innovation. So we saw some of the innovations and things that are happening in India at the moment, and I think there's some interesting things happening in Australia as well that we can draw out. So on the financial advice side, this has been a really interesting, I guess, market that's been evolving for about a decade now. So go back to that timeline I showed you a few minutes back with some of the financial reforms that happened there. So 2012, we had some big changes to the way financial advice was dispensed in the market. So upfront and trailing commissions from advisors who routinely recommended active managers. That was fairly systematic. they were removed in 2012. So that was a real democratization of the financial advice system. And not only were commissions and those sort of incentives to sell active funds removed, but there were also, the compliance regime shifted the bar a lot higher. So advisors had to really justify why they were selling active management to individual investors. So when you've got a product that is 1% more in terms of underlying fees that isn't necessarily outperforming, and you've got passive products sitting on exchange, readily able to be executed, it was actually very difficult for many advisors to continue recommending active products. And so you see there a big shift in the way that advisors are using active versus passive. And the other key sort of regulatory landscape change was a royal commission, so a government investigation into the banking sector, which happened between 2017 and 2019. And what this resulted in was the compliance cost for banks and that sort of integrated model where many investors traditionally would have their main bank. They would go there for their banking, their mortgages, their financial advice, their insurance. That model of kind of embedded service really became unwound. And so a lot of the wealth divisions from those banks were spun off. And so it went from really vertically integrated advice models to very much independent financial advisors across the market. And simultaneously, you also had a big shift of bank research teams, also spun out of that system, and they formed effectively independent asset consultants. So now we have a situation where we have a large number of independent financial advisors, we have independent asset consultants who concentrate very much on asset allocation as a theme, a little bit less on individual investment selection. And so that really, when you start to lift the level of the conversation to more the asset allocation level, that really plays into the hands of passive investing as well, because you've got those core building blocks of passive portfolios that really become the conversation point. So you can see on the chart there, the grey area in the middle, that's effectively the bank-aligned financial advisors. That's effectively gone to zero over really a 10-year period. And overall, you're looking at the total number of advisors across the Australian market is actually shrinking. So there's not only investors paying for financial advisors for their service, but you're also getting this shrinking pool of advisors. And so you're now seeing a lot more investors also outside of the financial advice world, and actually self-directed investing as well has also been on the rise. So another couple of interesting stats just quickly on that theme as well. So the orange area on that chart on the left looks at the number of advisors that are using ETFs or recommending or intend to use ETFs. So that's gone from really, just over 10% in 2008. So over a 15-year period, it's now around 70% of advisors are using ETFs. So it's been quite a stark shift in the way that market has attracting ETF inflows. And you can see on the chart on the right there, active management very much still the largest segment, but year on year that's been declining from 40% of new assets going into advised portfolios down to under 25% in 2023. Index funds have been pretty consistent across that period, but ETFs up from around 3% to 15%. So still definitely active funds are a larger segment of the market, but the momentum is very much in favour of ETF investing. Okay, so the other big trend, active versus passive. So I think everyone here is likely to be familiar with the SPIVA report. I think that's fairly commonly quoted numbers, but looking at this for Australian investing in particular, you can see in the orange there that around about 20% of active funds are outperforming the benchmark on Australian equities. If you look at that on a consistent basis, there's almost no funds that have been in the top quartile for more than a few years in a row. So again, this very much comes back to the idea of what is the incentive for advisors to recommend active, and is active really that I guess the compliance costs associated with those recommendations has become more and more difficult. And you can see here as well, just the flows from active into passive. So active funds, outflows, net across the market year on year, 5 consecutive years. Passive, and that's including both ETFs and index funds, positive inflows over the last 4 years. And overall, looking at the overall market share, just to give you a bit of context there, passive is now around about 15% of the total market. So definitely a strong amount of growth there. But I think really the key piece here is that in many ways it's not so much active versus passive. It's really around how investors are looking at portfolio construction. And I think that's probably the key to the conversation here is, if we rewind to, say, 2017, when we launched the first thematic ETF in Australia, we started talking about core versus satellite investing, and that was really, in some ways, quite foreign to a lot of advisors at the time. Look at it today, that's pretty much the benchmark in terms of how investors think about the universe of investing. And so I think it's a pretty routine conversation these days to talk about what types of products fit in the core of a portfolio, and that's where you have a lot of those conversations around low-cost, passive, broad benchmark type product. And then a lot more of the interesting conversations come around those satellite allocations. So that's where you're talking thematic ETFs, you're talking cryptocurrency, you're talking alternatives. And so that's really where I think product innovation can add a lot of value going forward as well. So I think there's really two themes. One relates to core, and the other really relates a little bit more to thematic. So on the core side, one of the real trends of 2023 for us in Australia has been cost compression. So we've seen Vanguard, we've seen BlackRock coming in on Australian equities in particular, slashing fees. We've seen one of our domestic competitors responding in kind. So we have ASX 200 funds now priced at 3 basis points when they were more around the sort of 14, 15, 12 months ago. We've seen BlackRock again throwing their weight around and launching new products against existing issuers, like-for-like products, 50% or more reduction on management fee. So it's very much getting to be a very competitive industry, and that's really been a bit of a game changer for the way, again, people are using these types of products in that core allocation. On our side, we've seen competition on gold ETFs in particular. That's been a big area of focus and something that we're looking at. But I think the sort of, I guess, the but on this slide is for ETF issuers, in that type of product differentiation and doing something other than looking at price is becoming much more crucial. So really, if you think about historically, things like research, very much the domain of active managers. They had the research teams. Passive was very much, here's a product, you know what it does, you make the choice. And I think that's really changing as well. So I think value add from ETF issuers is another big theme. So we're seeing things like research teams associated with ETF issuers. That's a big part of the value add from Global X. So we have a big research team dedicated to things like thematic investing, income investing in particular. And the other one is around, I guess, the value-added service to investors. So things like digital tools to analyze portfolios. And so really differentiating on the brand and on the issuer as well as the product is becoming another key theme that we're seeing across our industry. And I think lastly, just on product development. So Swarup referred to earlier, I think there's going to be some exciting things coming up for the Indian market. But from my perspective in Australia and what I'm hearing more broadly, I think the key at the moment, or the main focus is fixed income. That's definitely an area where we're seeing a lot of activity in terms of flows, but also in terms of I guess, product proliferation as well. So we brought to market in Australia about 18 months ago the first US Treasury bond ETF, which has been fantastically successful. It's been the fastest growing product, or the fastest growing new product in Australia over that whole period. And already we've seen 5 new products following that same theme. So short dated, long duration, inflation linked, you name it. So the product proliferation is definitely there. And there's a lot of, again, comes back to that point around competition. But I think there's a lot more to go in terms of what can happen in fixed income markets. We've seen so much innovation across equity markets, different ways of slicing up the market, but fixed income has really been domestic, international, government, credit, and that's about it. So I think there's a lot of different things happening there around targeting different duration, around fixed tenor, around fixed maturity, and we're seeing some of that playing out in the US and in Europe at the moment. Alternative income is another big area of focus of ours. So when you've got rates picking up, trying to generate additional yield becomes more and more challenging. Across the Global X product suite around the world, covered calls are a really big area of focus. We've had some massive success in those sort of products, particularly in the US, something that we're working on in Australia at the moment. So I expect to see more innovation around those sort of products. Digital assets, cryptocurrencies is one I mentioned earlier. On our side, we're very pleased to have these products in the market because we think that we don't quite know how those markets are going to evolve, but we think there's a lot of opportunity there to be the first mover and to evolve with those markets and to bring new things to market as they emerge. And then thematic investing as well. I think there's been a lot of activity in that space, particularly in that sort of 2020 to 2022 period. One thing that I think is really, the theme above all themes is artificial intelligence. That's something that many products are sort of, I guess, involved in a kind of tangential way. So at the moment we have a fund focused on semiconductors, which really benefits from the theme. We have a robotics fund that also benefits from the theme. We have large cap tech stocks, which benefit, but I think pure play AI products, which I think you have on the shelf here in India as well, are a really interesting area. And I think, as more and more pure play companies become available in the years to come, that's going to play out in a very interesting way. And I think the last one to mention there is just emerging markets and the India story as well. So we actually have a nifty 50 product on the shelf in Australia, which is seeing a lot of interest at the moment. That's something that we talk about almost on a daily basis. And emerging markets ex-China is a big story as well, one that comes up very regularly. And I think that really resonates with the India growth story as well. So that's something that we're really excited to be talking about domestically, and we've been running some seminars with clients this week actually. And so I think on that note, I understand there's some questions from the audience coming, but otherwise, yeah, I will be back for a panel discussion a little later on as well. So thank you very much. Or not.
Hi, good evening, sir. This is Akshay. How is the liquidity of ETF in Australia and how it is managed?
Sorry, I didn't quite catch that.
Akshay, yeah. How is the liquidity of ETF in Australia and how it is managed?
Do you understand what? It's a bit hard to hear what's that. Oh, liquidity. Yeah. Sorry, apologies. Liquidity is actually a really interesting point. So we've had quite a lot of, I guess, evolution in terms of ETF liquidity. So go back a few years, and we had 2 key market makers that pretty much had a duopoly across the market. So Susquehanna and Deutsche Bank, and Deutsche actually pulled out of our market in, I think it was 2018. So that sort of left ETF liquidity in a little bit of a limbo, which was a slightly interesting time. But since then, it's been pretty much only upside. There's been some changes in some of the incentivization programs from our exchanges, and that's really encouraged not only foreign market makers to come into the market, but also some development of some local businesses as well to support the market. So now we've got two ETF market makers that really cover the entire market, and then you have a whole range of additional market makers that are across a large portion of the market as well. So really, almost every product has at least 3 market makers competing on price, which really does give you that assurance around liquidity. We saw over the COVID period that there was no concerns around liquidity. The market, even in stressed markets, that people were able to trade in and out of most of the ETFs. And I think the other thing that we're seeing is also an evolution of how people are using the capital markets functions of ETF issuers and actually tailoring their execution to their own preferences. So doing things like negotiated OTC trades, doing NAV trades after market, a whole range of different execution alternatives on the, particularly on the institutional side of the market. Good. Thank you very much.
Stay on the stage, please. I'd like to call upon Swaroop once again to felicitate Evan. Okay, we're doing that later. Okay. All right. We're going to set up the stage for our next panel. It's a very exciting one, but till we do that, here's a quick shout out to all of us, those of us who are watching the event at their homes, their offices on YouTube right now. There's a very exciting quiz on for you. So please engage in the quiz, send us your answers, and stand a chance to win vouchers at the end of the event today. So those of you who are watching us on YouTube right now, this one's for you.
What? Investing in ETF is easy. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Here's a quick shout out. Firstly, thank you so much for tuning in. And secondly, we have a very exciting quiz going on for all our online viewers and participants. Please check it out, send us your answers, and stand a chance to win vouchers at the end of Innowave today. Right on, and address the business case for passives. How can ETFs and funds of funds be used in client portfolios? How to achieve that right balance between profitability and investor interest? What should be the strategy to increase investor participation in ETFs? With our next panel of guests, we'll be discussing all this and more. So let me start calling them up on stage one by one. We have with us Umang Papneja, the CEO of Julius Baer India, joining us for the panel. The next guest is Vijay Chandok, CEO, ICICI Securities, with Pradeep Dokania, co-founder, Sycomoro Advisors. And let me also call our moderator for the day on stage, Siddharth Srivastav, Head ETF Products and Fund Manager at Mirae Asset Investment Managers. Welcome, guys, and thank you for joining us.
So we had a very insightful presentation by Swaroop, then by Mukesh, and then Evan gave a very good description on what is happening globally. So we typically always talk about active versus passive, but it is also important to understand how in client portfolio passive fits in, right? For Mirae Asset, it is never a question of active versus passive. It's always been active and passive. And also from various channels point of view, people who are actually advising and pushing this in clients' portfolio, how does it make sense from a business point of view, right? There is, as people spoke earlier, total AUM is around 7.6 lakh crores, right? More than 16% of industry's AUM is now passive. We have 380 products across market cap categories, across smart beta strategies, across themes, sectors, etc. But it is also important to know what sort of opportunities these three gentlemen see in passive domain, not only from investor point of view, but also from their organization point of view. So my first question, which is to all three of you, is what is the thought process when it comes to passive funds, and what opportunities do you see in this space? Umang, if you can take this question first.
Sure. So the opportunities, so first let's take a step back and see how the passive industry has evolved. So I remember not many years ago, just a few years ago, if you wanted to allocate something to passives for an HNI, the HNI would become a very significant part of that fund because the size itself wasn't there for most ETFs. And as Mukesh mentioned, that as the EPFO came in and the CPSE came in, I think the total AUM in this segment changed. Now, I think that phase, we are now looking at, I think, around 7 lakh crores, including the debt passives. Now we have reached the size, and as the slide also mentioned, 22% of equity AUM is passive AUM. The next phase, according to me, is innovation around these ETFs. So either the innovation happens through the mutual fund industry, which I think Mirae has already done through a fund of fund, or innovation happening through wealth managers like us, where we can probably do some passives around a PMS. So I think the next phase is going to be the innovation around whatever the industry has built. That's a sizable opportunity in my view.
So Pradeep, what is your view on this?
Sound is not clear somehow.
What is your view on this?
No, the opportunity for passive and ETF, we believe it should be a strategic part of the opportunity. I think at the context, maybe we covered a lot of things. But let me see what has happened in India, and if somebody had invested in indices, what's the kind of returns they would have made. And passive and ETF around passive and smart beta gives you an opportunity to participate in the market. I will give you some numbers. India today is a $4 trillion market, and it has a passive or indexes allowed. This is the value of the shares in the market as of today. Just to give you a sense, maybe abroad we have all covered, a lot of things were covered that which, if you look at Nifty, which started in 96 at 1,000, crossed 20,000 recently. So it has given a return of, I think if you look at including dividend, it has given a return of 13%. Most impressive has been the mid-cap index, which has started in 18th July 2005 at 1,000. And the total value of index today is 42,000 something. And the return and the total value is 57,000, given a return of 24.65%.
since 2015. Similar thing applies to other indices. So we see basically passive and ETF is a reflection of broad secular growth happening in the market. Today it is a $4 trillion. Our view is that it will continue in next 6 to 7 years. That's what all the reports are talking about in India. Our assessment is that India will be a $8 trillion market by 2029, 2030. So I think one of the ways of taking this return is to invest in passive. Let me just add one thing, that it doesn't mean that it is applicable to all the markets. The timing and the country becomes important. Just to give you a sense, Hang Seng index has given 0% return for last 26 years. So whatever was that index in 1997, even today the index is same. In fact, FTSE has given a return of 3% in last 20 years. So I think it doesn't mean that every market is the right one for that. In India, it is quite relevant because we are in a secular growth story kind of environment. We are expecting a nominal growth of 11%. So I think we are in that phase where passive and ETF makes enormous sense.
That's interesting. Vijay, what is your thought process? A lot of interesting things are being done on the broking side also when it comes to passive.
Can you hear me? Yeah. First of all, thank you very much for having me here. I think this is a wonderful event. I was listening to some of the speakers before this session started, and I sort of learned a lot, particularly the Australian market. Pretty interesting. And, you know, the way we look at the opportunity and our thought process around it, this is now increasingly becoming an unignorable part of the opportunity. Why do I say this? Just look at what happened in the last 3 years, right? It's grown by about 48% cumulative compounded. It's close to 8 lakh crore. And there are many legs more to grow. When you compare it with where India is just now, we are at about 17-18% of the total AUM of mutual fund industry with passives. Look at the more developed markets. It's a far higher number. In fact, US is half and half retail and passives and active. So there are the two legs for India's growth. One is the increased penetration that will take place eventually between active and passive, and the second leg of growth is the growth of the AUM of the industry itself, considering it's so underpenetrated. I also think there are some very big structural advantages that passives offers. Cost, which I think is very important for a very cost-conscious community like India. And we have seen, at least in the broking industry, if I can draw the parallel, what a cost advantage can do to participation in the markets. We've all seen what the discount broking pack has brought on the table. That also tells us one more lesson. Can this grow faster? I certainly think it can grow much faster than even what we've seen, 48%. It can probably exceed the next few years. But there are some challenges to be overcome. And I think that's where the opportunity lies for people. More recently, if you've seen some of the developments, and I'll probably put the names, some of the discount brokers have launched passives. You guys have launched passives in a more aggressive way than ever before, and you've also launched your discount broking platform. And I can see BlackRock coming in, and they're collaborating with Jio, and they're going to be coming into the market. I think these are very, very big disruptive moves that have happened recently in the industry, should be watched, because they can provide an inflection point and a disruption which this market is waiting for. One of the challenges that I think this will address is that direct access to the investors. And there is clearly a challenge today, one of the challenges which comes in the growth, that the business model for an advisor and distributor is relatively muted. And we saw the Australian example of what changes in regulation could do to the industry. So I think that disruption is waiting to happen. It's probably around the corner. So pretty optimistic. It is clearly becoming an unignorable part of the market, and I would actually anticipate a faster growth than we've ever seen before.
That's very bullish view on passive, Vijay. So Pradeep, coming to you, where do you think ETF fits in client portfolio? Like we all talk about Nifty 50, Sensex, core allocation, etc. So how should investor approach passive when he or she is thinking to create a robust portfolio?
Sorry, last part I missed. Yeah. No, passive can cover. I think I will give some examples how it can be useful. I think besides the broad market, smart beta is a part of it, can be used. But just to give you a sense, some of the uses. For example, we saw in the chart in India, NASDAQ index being there. Now, Indian market today, after reaching $4 trillion, is almost 4% of the global market. So I think ETF can become an opportunity to give global diversification, which some of you have been giving. I saw some very interesting funds from your side, I think artificial intelligence. Now these companies are not listed in India, but as India grows in maturity, the investors here will look at new themes. The other thing is a lot of sectors, and we went through the indices, are being created, and some of the sectoral funds can be done through ETFs. The banks are being done. Just to give you an example, 3 years ago, there was an opportunity. Public sector banks were trading quite cheaply, and one ETF was available. So, for example, that ETF became an opportunity, and it had become a three-bagger. So I see opportunity coming, one, in global diversification, a lot of industries which are not being covered, if we can bring in. I'm very glad to see that you have brought, beginning to bring some of those things, because every industry is not going to have a representation in India. And in India, I see more and more themes being represented by ETFs and passive funds.
I completely agree with the kind of innovation, as Swaroop mentioned, is happening on the passive side. It is much more what is sort of allowed on the active side. So thematic, sectoral, international. I think passive is evolving from just core allocation to satellite allocation also. What is your view and thought process on where does it fit in client's portfolio, Vijay?
Yeah, so again, early days, very early days, because even though we've spoken of these huge growth rates, retail is still not even started tasting it in a very serious way. Because out of this close to 8 lakh crore money that's gone into the passives, 80% of it is sitting in the institutional side.
Correct.
So retail HNI is actually less than 20%. So when you compare that with the AUM that exists in the industry and look at retail as an overall, it's hardly 3% penetration. So to say that it is becoming core and let's look at peripheral, I think there is a lot more story to go into become core itself, because I don't think even today it's a larger part of the core portfolio. So first, to my mind, when you think of from a client's point of view, we would, more and more encourage clients to start building a core portfolio through an ETF. And if it is inevitable, it's going to happen. It may not happen in the next 1-2 years, but I think if you look at a slightly longer time horizon, it will happen. There is also an opportunity for making it a part of the core portfolio through wrappers. What I mean is PMS wrappers and so on. And there are some very interesting strategies that a company like us have launched through the PMS route. So that becomes another play depending on the class of the investor. I think it's after this core story sort of gains momentum, then there is an opportunity for the peripheral area, the tactical areas, the thematic areas, and so on and so forth. Because today, other than the core propositions, liquidity is hardly there. So we need to sort of create liquidity. So there is some time to go before the peripheral picks up. But I'm quite optimistic that as time passes, as regulations evolve, as business models become more sure-footed, there is going to be a lot more growth on both the core part of it as well as the peripheral part of individual's portfolio. I'm fairly optimistic about it.
Thank you, Vijay. Umang, so Vijay said that most of the money which is flowing into ETFs, at least, is from institution, right? And it's still some way to go before it properly seeps into retail investors. And hence the very important conundrum that how do you address the conflict between active and passive, right? As soon as we start talking about passive, we simply try to compare active and passive, and it is also important to set the investor expectations right, because there are so many different type of passive funds also, right, and each cater to different goals and requirements. So how do you address that?
No, so I don't think, first of all, we should treat it as a conflict. So active and passive should go hand in hand. So since the onset of the RIA license, so everybody wants to, like most of our fraternity is going in that direction, where everybody wants to put most investments in direct plan and also give the low cost option. Now, whenever you make a investment policy statement now, when you sit with a family and their requirements, there is a clear demarcation of relative equity allocation and a benchmark agnostic equity allocation, right? So every family would be different. So somebody might say we want to be 80% in relative and 20% in benchmark agnostic. Somebody might be the reverse. So everybody has a different answer. But when you talk about the relative allocation, which is more benchmark driven, ETFs become the logical answer, right? And as Vijay mentioned, I mean that as more and more institutional participation has come, it has increased the liquidity of particular ETFs, although we are still a long way to go there. But that becomes one way to look at things. Second, also, as Pradipbhai mentioned, on the thematics, right? So let's assume that the advisor view is that banking should be a very high allocation. This is a hypothetical example. And you've invested in mutual funds, and you know that now the largest Nifty stock, because of the merger of two financial institutions, is more than 10%. It's around 14%. So a mutual fund cannot buy 14% unless it's a passive fund. So you can always use a thematic overlay if you are, you can do a financial services ETF or a banking ETF to get to that, at least the benchmark allocation, if not higher. So these are the two ways I think people are looking at it.
That's interesting. Pradeep, your view, how do you address this conflict between active versus passive, and how do you set the investor expectations right?
My view is there's no conflict. I think ultimately it's a part of the allocation process. In passive, we are looking at broad market or broad themes, whereas in active, very clearly the expectation is that we will make something higher than the benchmarks. At least the effort is there. Now, how many percentage do that? But at least we do that. So there is a room, and in a growing market like India, or I think that is applicable in global context also, there will be good fund managers who will make things different. So very clearly, I think both are part of allocation process. I won't see this as a conflict. I think as like Umang was mentioning, as the evolution happens, both will be a part of allocation process. Maybe it may vary in percentages client by client, based on the client's thing. And maybe some bit of cost or whatever.
So I think now we'll make it a bit tricky. I'll bring in AIFs and PMS and all the structures possible to invest. And in the era when we are talking about active MFs, AIFs, PMS, where does passive fit in when it comes to maintaining that fine balance between investor experience, what does investor want, and profitability, right? Because that also comes into play. So how do you balance that, and how do you think next 3 to 5 years that will be managed? So Umang, if you can take this difficult question first.
Sure. So, of course, there is, a wide range of products out there. So you've got PMSs, AIFs, but first let's understand that this is not, everybody cannot invest in a PMS or an AIF because of the large value tickets which they ask. But let's assume that we are only restricting, as you mentioned, to the HNI space at this moment, who has a variety of options to invest in. You're forgetting one advantage of mutual funds, which is the inherent postponement of tax, right? Because whatever buying and selling a mutual fund does, the tax you have to pay only when you exit, right? Whereas when a PMS or an AIF does that, you have to pay tax on the spot. So you can't take away this advantage. It's a very, very important advantage. Second, we also discussed about benchmark agnostic versus relative. But there is also one more allocation which most families look at, which is, you can either call it core satellite or lock-in and no lock-in, or liquidity, things like that. So core and satellite, what they see is that MFs should be the larger part of the allocation because of the advantages I told you. And PMSs, AIFs, generally AIFs give you only a 15-day NAV or a 30-day NAV. You have windows to exit. So it's not like a mutual fund, right? You can't wait. If you want to exit, you can't wait for the next exit date, right? So, so there is always a limit which most families keep on such products. And hence, when you look at it from that lens, the conflict really is not there.
Vijay, what is your view on this question?
Yeah, no, I just want to sort of comment on both the questions that you asked. I think they're great questions, and honestly, as a practicing business person, I must confess it's not an easy way to deal with this issue that you raised. I'll tell you how we try and practically address it in our company. To simply sidestep and say there's no conflict, I think would be very naive. That's what I feel. What we've tried to do is, the moment you start looking at it from a product lens, that, passive versus an active, then the conflict, segment level returns, etc., all of these become relevant. But the moment you pivot the lens of your coverage people, your coverage banker, relationship managers, client bankers, private bankers, to a client lens, I think the conflict disappears. Then it is a question of allocation. Then it is a question of doing things which are right. The entire lens becomes more long-term. You're interested in ensuring the longevity of your relationship with the client, because that's how you're getting recognized and rewarded. So I think it's important to recognize first and align it to sort of reduce friction and conflict. And that's how we try to do it. We also believe that, given the textured market that India is, there are market slots and opportunities for different categories of investors. And given the varied sort of market opportunity in front of us, you have people who are probably just not suitable for the AIF PMS at all. And you have a lot of people who are hybrid, who can straddle both. And a few people who prefer to, just take the AIF PMS and take the direct fund route. So we have the whole texture, and based on the client, we play the respective segment strategy. but the lens has to be the client lens to ensure longevity of client relationship, and eventually, if the client is doing well, we believe that we will also do well. So that's the way we try to deal with conflict, that's the way we try to manage expectations of the client, and that's the way in which we try to balance our own firm profitability.
That's an interesting take, Vijay. I think last question from my side will be while AUM growth is very fancy, you talked about folio growth as well, but there are a lot of challenges also in passives right now, ETFs and index funds. So as per you, what are those challenges when it comes to your setup, and sorts of what do you want to see for passive to evolve more and become, let's say, go-to product for the at least the initial investors into the market? Umang, if you can take that first.
Sure. So I think time heals everything. So there are, of course, challenges when the industry is growing and exploding. But I can tell you some challenges which we face on a day-to-day, but I don't think there's a solution. The solution comes with time. The biggest of which is liquidity, right? Now, when you look at international ETFs, you want to buy, say, for example, S&P ETF in the US or a gold ETF in the US, you've got, probably liquidity to the 4th decimal, right? That's the kind of ticker prices which they show, right? I don't think that is, we are far away from that, right? But maybe because the sizes of those funds are so big, they can, give you reasonably good liquidity for large sizes. Today we have to, for a large size, you have to call the mutual fund, and then the mutual fund does, that's not how an ETF is supposed to function. But of course, we are all living with this growth phase, and eventually we'll get there. So liquidity clearly is one problem. Second, of course, sometimes there are some slight issues in product construct, but which I think the industry takes a very, very quick feedback and change it. So I'll give you an example. On liquid ETF, there used to be dividend reinvestment, and the number of units kept on adding. And most of our families or, accounting softwares for corporates as well as families are not kind of accustomed to calculate all of this or kind of, do this seamlessly. So the industry heard, I think, all their investors' problems, and now most ETFs give out the dividend flat and they don't reinvest, right? So you get it on every Monday or whatever your date is. So that is an easier way because the number of units remains constant and your dividend comes for that week to you. So the industry is anyway listening to whatever minor constructs you want to do, but large part remains is the liquidity, but it will come with time.
Pradeep, your view on this?
Yeah, same thing. It's an evolving situation. I think it was mentioned in the presentation. If you go back in history, mutual funds started in early 90s. ETFs started only a few years ago. So it's a work in progress. Liquidity, market making, I think it very interestingly, your partner in Australia mentioned there are 3 market makers. Now we don't have that situation as of today. So I think liquidity, transparency, market making will become more efficient. And I think one of the news is the big gun is arriving here also. He mentioned about the firm which came to Australia and changed the context. I think bigger players coming up will deepen the liquidity, market making, transparency, turnaround time. This is what, and I think along with that, what all of you are doing in the industry is trying to have newer ideas, some newer themes. So I'll say the growth rate has been pretty good. It will evolve, and maybe some more competition will come. But as of today, liquidity, market making, these are the constraints.
Vijay, your thoughts on this?
Thank you. So I look at the Indian context and the challenges that are coming in the way of growth of this industry. I'll put them into 2 boxes. The bigger problems and the relatively minor problems. 2 big problems. that need to be fixed. And in my mind, the order is first remuneration of the distributing world for an ETF product. And number two would be liquidity, in my mind. And then there are smaller problems, knowledge can be better, innovation can be better, product range can be better, etc., etc. But those are, I think, second degree problem. These two problems can actually give the big impetus for immediate growth. What's happening here and how can we fix it? I think the first big issue, I can see some light at the end of the tunnel here. And again, I mentioned at the beginning of what I was speaking, 3 names. Mirae, you guys, some of the discount brokers who've just launched an ETF, and I think BlackRock, which is coming in collaboration with the Geo family, will have the opportunity of not just having a product as a manufacturer, but also having access to customers, so you cut the distributor out of the window. You have a business model which nobody has got. And I think that is one of the biggest challenges, number one challenge, even ahead of liquidity, that is coming in the way of growth. Liquidity is already somewhat available in the core products, the Nifty and BSE. And the growth of that will be provided by, I think, the disruptive players will automatically add to the liquidity, because that's somewhat of a chicken and egg story. So it is like a self-perpetuating story. So I can see, that's the reason why I said that I'm pretty optimistic about the growth of this, and we have to watch it very, very carefully. So that's how I feel the challenges are there in the Indian context, and that's what can actually help grow the Indian market. And I do believe in the next 2-3 years, we will see some lot of action, maybe even sooner. Then the smaller challenges can get addressed along the way, I suppose.
Thank you, Vijay. I think we have time to take 2 questions from the audience. So if anyone has any question for our esteemed panelists, please raise your hand. We can take 2 questions. Is there any questions from the audience? So I don't see any hand raised. I think I'll just conclude this panel. These 3 gentlemen have very sorts of well summarized the potential of passive, how they don't see passive versus active as a conflict. Ultimately, it is all about investor's portfolio and his experience, whether it is through active or passive or AIF, etc. Ultimately, the investor journey matters more than anything. While there are some challenges which is still there, especially with respect to liquidity, but we all hope that in coming years that will be taken care of. I'd just like to highlight that SEBI has recently come out with a guideline which seeks to sort of smoothen that process of market making of ETFs on exchange. With that, I'd like to thank Umang, Pradeep and Vijay for their very insightful comments on the questions. And with that, I'll conclude this panel.
Thank you very much.
Thank you.
Thank you so much.
Okay, before our guests leave the stage, I want to call upon Mr. Jizang Yu as well. He's the CEO of Mirae Asset Capital Markets, to give them a token of appreciation. Please give a round of applause. All right, thank you so much once again, Jizang, and to our panelists as well for an insightful conversation. The three of us, if they could take a picture together. Yeah. Okay, before we move on to what we have in store next, here's a quick shout out to all our audiences who've come all the way here to attend this very exciting event. There's a very interesting looking box, an interesting booth outside. That is our magazine booth. Please take your pictures there. Share it on social media, tweet it with our tags, Mirae, all the Mirae handles. Use the hashtag Innowave 2023, and you also will stand chance to win the vouchers by the end of this day. So all these prizes and goodies are not just for our YouTube viewers, our online viewers, but also for our offline viewers who've taken time out and come all the way here to participate in today's conclave. Okay, so moving on to our agenda once again, we have something very, very interesting in store for you, which I will not reveal. But to do the same, I want to call upon a host of our guests, starting with Swaroop Mohanty, Vice Chairman, CEO of Mirae Asset Investment Managers India, An, who's the Chief Business Officer, Taiwan Kwon, who's the Chief Financial Officer, and Patrick Lee, Director, Head of Business Management Division of Global Business Unit. Guys, please come on stage for the big reveal. And may we also request some of our other guests also to join them on stage. Ashwath Rajan, Director at Business Development and Client Solutions, YouGov. Okay, so all of them have put together something very special which we would like you all to see before the reveal happens. So please take a look at the AV. All right, it is here, so I request everyone to make the big unveil. Ashwath, I want to request you to stay back because we want to talk more about this unveil we just had, decoding ETF perceptions. Why don't you enlighten us about what this study entails and yeah, tell us more about it. Come on.
Thank you so much, firstly, for the opportunity in what looks like an extremely successful event. I'm Ashwath Rajan from YouGov. We are a consumer research agency, and we've partnered with Mirae Asset to produce the first of its kind primary research, which is titled Decoding ETF Perceptions. While the report has a lot more details, I'll take you through a few glimpses of what we have. Primarily, the report covers the profiling of the cohorts that we've done. That's the first part. What causes the people to invest in ETFs? What are certain concerns that are there? And finally, the report will sum up looking at a few marketing channels through which we can reach out to these potential investors. Okay. Can you help me with this, please? How do I go back? Before we get into the report, I wanted to give you how the construct or the sample design of the entire survey has been done. We've gone predominantly to males, 80% males in the survey, 20% obviously constitutes women, in the age group of 22 to 55, in the top 15 investing markets of India. Now, from an awareness perspective, at an overall level, the category awareness sits at about 30%. We heard from the previous panel discussion that there's a lot more room for penetration, and our data pretty much verifies, validates that from the consumer side as well. But because this survey entails a few questions and an entire section on ETFs and what prompts them or the concerns for them to invest in it, we've gone to an audience that's pretty much 100% aware of the category. In the first aspect that I want to take you all through, the first distinction that we come up with when we look at the three cohorts that we've defined, owners, intenders, and non-intenders. The definition of this is owners is someone who's currently investing in the category. Intenders are someone who've not started investing but are open or considering to invest in the next 12 months. And lastly, non-intenders, who are pretty much people who are aware of the category but are not in the consideration to invest in the next 12 months. In the construct of the survey, the first thing that distinguishes or the difference that comes out between the three cohorts is the fact that a bulk of them sit in the tier 2 for owners. And if you look at non-intenders, from an age perspective, they are much older. The 46 to 55, that's the age group. Owners specifically fall in the right bracket of the 36 to 45. Again, these are the breaks that we've gone to in the survey. Moving on to a little more detail in terms of the profiling. We'll go one at a time, first looking at owners. From a life stage perspective, they are a little more mature from the other two cohorts. That means there are 74% of them who are married with kids. They are obviously a lot more affluent. 1 in 2 people who've claimed to be owners of the category have a net household income of 1 lakh or above. And to reinstate this point on affluence, we ask them what is the kind of smartphone you own. So 37% of them own a smartphone in the range of 31 to 50K. When we look at the other two cohorts, you'll understand that's larger than what the others are doing currently. Again, another point reiterating on the affluence. If you look at the extreme left side on the OTT usage, you will see that the paid apps, say for example, an Amazon Prime or a Disney Hotstar, that comes up for the owner cohort, and YouTube, which is a free app, is a little lower on their list. The same thing when we move to the intenders, right? Those are people who are open to invest in the category in the next 12 months. Again, in a slightly mature life stage, 72% of them are married with kids. They spend a lot of time on the internet, slightly lower in affluence than the current owners. 41% have about a monthly household income of 1 lakh or above. And the question on smartphones, it brings them down to the next bucket of ownership of smartphone between the range of 21 to 30K. The third segment, which is the non-intenders. Here, if you notice, from a life stage perspective, it looks like they are a larger chunk are single as compared to the other two, less affluent, and this also is reflective with YouTube coming as the top OTT app that they are using. Moving on to the general investment behavior, this is so that we get an idea of how the overall response has been. 62%, nearly 2 in 3 people whom we surveyed are saying they use SIPs, which is obviously one of the most preferred methods. And more than 50% of them claim that 11 to 30% of their salary is what they invest in general. Looking at this specific to the ETF category, what we have is, we did this comparison between owners and intenders. Both of them, from a similarity perspective, look at ETF as a long-term investment option. So there's 73% of them sitting within owners, 75% of them sitting within intenders, both saying that ETF is a long-term investment option. Obviously, the term long-term is subjective. Owners see long-term as anywhere more than a year. Intenders see that more than 3 years above. But the difference between the two cohorts when it comes to the ETF category is the percentage of salary that they're looking to invest. So if you look at the two pie charts that are there, within the owner segment, there is a larger chunk of people sitting in the 11 to 25% or 25 to 50% of their salary, which they would be open to invest in ETFs. That number is at the 6 to 10%, 44% that you can see over there. That is 6 to 10% of the salary of intenders. Moving on to the next section, this is where we looked at the triggers and barriers, like we call it, which is basically reasons to invest and concerns to not invest in the category. Firstly, important factors for ETF selection between owners and intenders. The top reasons come up as liquidity, expense ratio, and the asset manager, which is higher for intenders. So while these are fence sitters, they are aware of the category, these are the small cues that we have that from a knowledge and awareness perspective, it is much lower for them. The same thing, while these are big reasons for owners, if you look at the AUM tracking error, these are higher from a percentage perspective versus the intenders. And if you look at what are the important factors for ETF transactions, between owners and intenders, there isn't too much difference. Liquidity and market speed are two reasons most of them have quoted for it. Moving on to the triggers, which is basically what are the reasons for people to invest or reasons for people who consider to invest. We've asked this specifically to the owners and intenders cohort. Both of them have said better liquidity and has better returns as major factors to invest. And when we look at the barriers or concerns, which are obviously asked to intenders and non-intenders, The point again reiterates of lack of awareness, which is the second highest you can see, and the fact that they perceive it to have hidden risks and and high risk. Now, what is interesting to see here as well is that lack of trust and complicated as a process are not really coming up. So from a derivation perspective, you can look at it like while the knowledge awareness is lower, since lack of trust is not a major barrier, education to this cohort will be an easy way to, push them towards the cohort of owners. From an expectation from ETF, across categories, across cohorts, generate market returns and outperformance of active funds are what they've quoted. Getting into the specifics of ETF as an investment strategy, while both owners and intenders use it in their core portfolio, there is a significant difference between owners and intenders when it comes to the satellite or tactical portfolio. 59% versus 46% of owners say that they will use ETF as an investment strategy in their tactical and satellite portfolios as well. And when it comes to most exciting ETF categories, market cap based as well as sectoral are the two largest, but we don't see any differences or nuances between the two segments. The last thing which we said we will touch upon is basically where is it that they get the awareness? What are the sources of awareness for ETFs? At an overall level, we see third-party sites and social media being the top. We also see video app sites like Netflix, APEV, which are there. And we also did see something like YouTube in their initial profiling. So these are channels which we could look at to tap into these guys, educate them, and hopefully that will entice them to get into the category and become owners in the future. So in summary, what we are looking at an overall level is that, like I have said multiple times already, awareness and knowledge needs to be built in the category, especially within the intenders and non-intenders category, cohorts, sorry. And because trust is not a major issue, if this is done in the proper channels, it will be easy to kind of convert them to owners going forward. From a target audience perspective, Tier 2 cities, which is your 15 lakh to 50 lakh population, they present the largest opportunity. People in a slightly mature life stage, mature investment stage as well, in the age group of 36 to 45, with a fairly higher income, becomes the core TG to look at. And from a communication perspective, while third-party finance, personal finance sites, and social media were the top two, the other ones which we can look at, because intenders and non-intenders are more present on those channels, is the YouTube way that we could go. And obviously from a hygiene perspective, looking at TV and advertising through newspapers and magazines, which is something universal for the BFSI category. That is also something that we can be looked on. So this is pretty much a glimpse of what we had. The report is in a lot more detail, and I think y'all can have the copy of this, and I would be there at the end of the seating. In case any of y'all have any questions, I'll be happy to interact with you. Thank you so much.
Wait. You worked so hard putting together all this, study and report and research on ETFs. So Mirae wants to give you a small token of appreciation. Let me call upon Srinivas Khanolkar, who's the head of product, communications and marketing at Mirae Asset Managers. Please give it up for our guest. Okay, before we move on, here's a quick update for everyone who's watching us online. The next set of questions for our online quiz is uploaded. Please check it out. The link to it is in our YouTube description. You still stand a chance to win those very, very attractive vouchers. So participate in the quiz right away. Okay, let me come back and focus on the conclave for everyone who's here and everyone who's watching us online. Our next panel discussion is on why and how ETFs can be used in clients' core and satellite portfolios for taking long-term or short-term tactical calls. And to talk about this, let me invite our next set of guests. Mr. Shekhar Jadhav, he is the Chief Investment Officer at Probity Advisors. Umesh Rathod, he is the Deputy General Manager, Finance at NABARD. Mr. Manish Dhawan, Deputy General Manager, Finance at NHPC Limited. Mr. Mani Shankar Mandal, he's the Head of Investments, Alembic Pharma Group. And lastly, Ms. Anjali Dave, she's the Head of Group Treasury, ACG World Group. Please join us on stage. And our moderator for the session is Sanjay Patni. He's the Associate Director and National Head Institutional Sales at Mirae Asset Investment Managers, India.
Let's have this. Just confirm if I'm audible. Yep. All right. Good evening, everyone. I hope all of you are enjoying the sessions which have been there till now. I think we heard Swaroop talking about the growth of ETFs in India. I hope we heard Mukesh from NSE, who was actually telling you the breakups of the markets, how it's evolved over a period of time. We also heard from Awan from Australia, and we could actually see a similarity between the two markets, the way things are growing. So I think I can only tell you that after these sessions and the panel discussion, which was from the distribution side as well, was very clear that how it is connecting with the audience. And if you go back to the recent, the YouGov, the survey which talked about, it actually pretty much connects that today you are actually finding it very important and a segment that the retail side of it is supposed to grow from here as well. Institutional, of course, remains that. Now, let me introduce myself. My name is Sanjay Patni. I head institutional business for Mirae Asset Management. I'm based in Mumbai office. Been there in asset management business for almost 19.5 years. I can truly tell you I've seen this journey of ETF, and that is where it's very close to my heart from day one. I think that's what we have seen it growing at a rapid pace. Also to tell you one more thing very critically, I'm sure all of us watch cricket, right? Right? I have Awan here. Sorry, Awan, but yes, India and Australia played very well in the finals. Yeah. But having said that, I think we all agree, though our heartbroken, maybe India might have lost finals, but India did play well. Can we have a round of applause for the Indian cricket team for doing that well in the World Cup? 10 out of 10 matches was it was a great thing. 11th match we lost, there is no doubt about it. But also I will tell you, let me connect with the cricket. Every cricketer always goes through something called a bread and butter shot, okay, which is a hook. This is what he likes it. One thing I can tell you, you saw Sourav Ganguly long back. He was always offside. He was a fantastic batsman. Anything offside, he'll hit the four. You found Sachin Tendulkar after that, straight drive, and he will be the genius of that shot, no doubt. Here comes the Virender Sehwag. Anything gives the loose, he will go all out, and he will definitely hit a 6 out of it park. And well, lesser said the better about Surya Kumar Yadav. He has changed the 360-degree game of cricket. Okay. So I think small thing which I want to connect with you here, investments are also 360-degree. We have seen active world growing over a period of time. I think from here, we will also find very interesting theme which is related to passives and the ETF business growing, and we have really seen that growing from here. And that's where, when you find gentlemen of these stature, two things I can tell you about these 4 gentlemen in the panel here. One, all of them put together are managing more than $12 billion of assets, okay, across the various asset classes. Second, they're all from India's 4 different locations today. Third, they all belong to 4 different category of investors that will also make it very interesting for you to gather their thoughts. And maybe after the whole 30 minutes of discussion, you might find something really interesting for them to talk about it. So thank you, gentlemen, for taking out time and traveling to India, traveling to Mumbai for attending this session for sure. So let me go to the session specifically talking about it. I think it's a ETF opportunities in clients' portfolio. I think very, very, very important topic. So let me jump on to the topic maybe straight away, how it's important. So Mani, maybe let me go to you first. I mean, very basic question, should one consider ETFs in the portfolio first? That's more important to me. Maybe does it have merit as you find it? So maybe if you want to share with the audience.
Sure, Sanjay, thank you for the question. So being in a job of an asset allocator, first thing that we look at is a client's risk profile. Along with that, we look at the time horizon of investments that they would like to have and the mandate that has been given to us from different clients. Now, if I kind of bucket two different kind of extreme side, one being a market portfolio, which I would like to call ETFs or index funds, and in the other extreme, basis variability of return, I am looking at, say, risk assets, which can give you high alpha. And in between, there can be other buckets also, which could be large cap, flexi cap, mid cap, different sort of funds. But two extreme buckets I'm kind of trying to create, looking at the variability from the indices. Now, depending on the risk tolerance level of a client, we would kind of look at market portfolio, and we will look at this high risk alpha generating portfolio. We will change the allocation basis what kind of risk that a person is willing to take. That is, what kind of variation that a client or investor would like to have in his or her portfolio compared to the market. Now, why I say the core portfolio or the strategic portfolio has to be ETF? The reason being, there are two kind of reasons I would like to kind of highlight here. One being the chances of underperforming vis-a-vis market is very high when there is a prolonged tough market condition, which we have witnessed, say, between 2017 till 2021, wherein market was a little bit polarized. Small mid caps were not doing that well. Second reason being, with dissemination of information, the quickness, the technology, and the regulation, basically SEBI, the top 50 to 100 stocks are covered by at least 40 to 45 analysts each. And there is a huge depth and width in the market. And hence, the transparency in data sharing is quite humongous. Yep. And hence, the possibility of having information arbitrage for active managers is going to be difficult. It is evident now, and it is going to be much more vivid and evident in future as well. Now, having said that, it can be easily calculated using a matrix that I would like to highlight. Say, for example, the alpha generated by an active manager to the kind of excess fee that you are paying. If you just look at a ratio of that, you will easily make a sense that probably ETF is a better choice compared to an active management. Now, from a fundamental practice that are being in India or in global, I would just like to highlight two schools of thoughts. One, for example, is a Norway endowment fund, which completely believes in 100% passive investments. Their entire endowment fund is passive. On the other hand, the other school of thought is, for example, Swensen endowment plan, which is basically a Yale endowment fund. They believe completely into 90% active management. The most of their 90% of the portfolio is basically into alternative assets, which are focused primarily in real estate, private equity, and hedge funds. And 10% is passive. So there are two different thought which is in practice in the market. So while framing a portfolio for our clients or for ourselves, one should definitely look at creating a solid framework and make portfolio according to the risk appetite of the investor. This can be easily followed for debt portfolio allocation as well. This is basically just a barbell strategy, right? So for equity, what we are following, same can be exactly followed through debt also. A core part is being indexed and the other part being active.
Sure. So, Shekhar, to extend that conversation, where are the ETFs headed in that case? Do you also consider similar what Mani's talked about, or you have seen something different?
No, absolutely. So I feel, understanding how we want to construct the portfolio and fitting ETFs where you want to have pure exposure to the market as a core, I think that's a very critical idea, a critical point to consider. And on top of that, whatever you want to do as a satellite portfolio or asides of the core, that's where you can take exposure through thematic ETFs, or you can take exposure through gold or any other commodity ETFs or international ETFs. So from an Indian context, it also gives you the ability to have a different currency exposure. So that's also very critical. So I completely agree with Mani on that.
Sure. So, Umesh, if I were to move to you, head-to-head comparison within the large cap category, maybe, is there a cost advantage in the long run? You come from NABARD, a large house. What has been your experience, and you maybe want to share with us?
Yeah, so we started ETF investment post 2015 after change in EPF investment pattern for self-managed superannuation funds. Yeah. So as per that, we need to maintain 5 to 15% equity of our net addition during the year, whereas for managed mutual funds, that limit is 5%. So you necessarily need to have some portion of ETF in your portfolio, or you need to run a proprietary trading book. Yeah. So PF being an additional activity for most of the large PSU treasuries. So instead of having a separate trading book for superannuation fund, we went ahead with ETF. And since we have both the funds in our book, so that comparison is naturally will occur from time to time. So we have seen that case since because of the cost advantage in ETF, when we hold it for a longer tenure, particularly for 3 to 10 years, definitely it's advantageous to us. So what we have done, core portfolio we are managing through ETFs, and a tactical portfolio which we churn and which we redeem either based on our market view, or we redeem it for payout to the pensioners, that we manage through managed equity funds. So definitely this core portfolio, we feel that it definitely performs better because of the cost advantage available with ETF.
So within 15%, the passive plays the biggest role vis-a-vis?
Yes, eventually, because we have realized that cost advantage of almost 60 to 70 basis point is too good to ignore. So our incremental allocation is more towards passive than active funds.
Sure. So Manish, if I were to move to you, I mean, in the similar vein what Mr. Rathod is talking about, ETFs have been part of superannuation fund and the retirement fund as well. How have you been able to use it or make it count effectively?
So,
maybe you can give it.
Hello. Yeah. So I would like to give a background first, maybe for the audience. 2015 EPFO come with a circular, and they started the journey of ETFs into the superannuation funds, wherein 5 to 15% of the annual accretion made mandatory for EPF investments. Yeah. So what is annual accretion? Annual accretion is whatever money you are getting on yearly basis as a contribution to the of members, and redemptions and interest, and after making your obligatory payments, whatever is left over is your annual accretion left over for the investment. Yeah. So in our case, roughly that is around 7 to 8%, 9% of the AUM. Sure. So of that 8 to 9%, you are allowed 5 to 15%. Yeah. So even if you go for the full 15%, typically you are investing only 1.5% of the AUM into the ETFs. Yeah. So this is a rough calculation. In 15-16, EPFO itself invested 5%. They kept their cap at 5%. 16-17, they enhanced their cap to 10%. Then 17-18, they enhanced their cap to 15%. Yeah. And 15-16, their investment was around 6,500 crores. That's it. And this year, Q1 24, they have invested around 13,000 crore in Q1. Yeah. So it's a 8-time fold into the ETF investment from EPFO itself in superannuation fund. So likewise, exempted trusts are doing the same. In our case, we were little lagging, but we have also made ourselves aware of the fact that without making 15%, we are not going to make up a portfolio for a longer period of time. So last 4 years, we are doing 15% of the accretion, and as comparison to EPFO, they have around 9% of their AUM in ETFs. So we have around 6 to 7% of the ETF.
Sure. So basically, you are saying that large caps will remain expensive. That's what you're saying that. Because your flows will not die, for sure. Okay. Let me move to Shekhar on that side. Shekhar, we are talking about domestic ETFs, domestic funds, global ETFs, and has that helped you because you are investing globally in various pockets, maybe India and US more prominently from your perspective? Has that helped you, and you want to share your experience?
Yeah. So definitely. So as I said earlier, from an Indian portfolio standpoint, it always makes sense to diversify some bit of your exposure through global ETFs, which also naturally gives you a currency exposure. Indian currency, you've seen through many decades now, it's a depreciating currency. So, having some exposure globally, which gives you dollar exposure, makes sense. So that's one. On top of that, some of the thematics which are available in the global markets are phenomenally good, and that is something which we are probably lacking in the Indian context. We don't get those thematics in India. You don't get some of the commodities which you are able to take exposure. Again, those are not available in the Indian context. So, taking some example, robotics, AI, crypto, or uranium or any other commodities which are for which we don't have ETFs in India. So, from that perspective, again, it definitely makes sense to have global exposure in the Indian portfolios through these some of these thematic ETFs. Yes.
So Mani, you also share the same thing because globally ETF markets are definitely more evolved, and I'm sure Avan shared the data as well. You've also seen some drivers out of it?
Yes. So basically, in our portfolio, some of the kind of themes that he mentioned, for example, big data analytics and AI. Biotherapeutics and biologics. Similarly, autonomous vehicles. These are kind of themes which doesn't have any proxy in India to play with. To have a diversification and to take an advantage from the global market, one should definitely look at it from a portfolio allocation perspective. And so that is where, and these are mega trends. These are going to be the driver for next decade. And this automatically becomes a part of the core portfolio. Now, depending on what kind of risk appetite a client has, you can cap the allocation to this kind of mega trends accordingly.
Sure. So let me flip the other side because people talk about equity ETFs. So Shekhar, I'm sure we had a long chat on the debt ETFs. That's being another opportunity which is not being looked at. Have you witnessed, have you utilized it? Or is there any suggestion from your side on the debt ETF side?
No, yeah, definitely. So debt, of course, we saw some of the numbers in the earlier presentations. So equity definitely is fairly high in terms of the AUM right now. But in my opinion, debt also makes sense to invest through an ETF route. And we have the largest debt ETF, which is the Bharat Bond, which everybody loves on the street. And apart from that, you can get GSEC exposure through target maturity funds. I think Swaroop mentioned about that. One innovation, and then everybody latched onto that and created such a large industry through target maturity funds. But of course, debt ETFs of late, probably because of the tax changes, are not in favor. But I'm sure over a period of time, as we see equity ETFs picking up, I'm sure debt ETFs will also pick up and make sense to invest across, not just the GSEC, short-term, long-term, but also through corporate bonds where anyway we probably there's hardly anything available. So yes, definitely debt ETFs, as of now, a fairly small section, but it will grow over a period of time, I'm sure.
I'm sure GSEC and corporate bond markets continue to grow from here. So in terms of size and the scale and liquidity. Yep. Mr. Rathod, if I were to move to you, operational convenience of managing managed funds versus you talked about, prop equity versus equity ETFs for pension side, etc. What's been your experience and how does that work for you?
Yeah, so one of the main advantage which was already flagged during the presentation, it offers you the real-time NAV.
Yeah.
So you are not dependent on end-of-day NAV. So you can very well take the well-informed decision. And similarly, at the time of redemption also, you get the current price instead of waiting for EOD NAV. So that is one of the biggest advantage. And another advantage is if you are having a prop book, then if you do any churning, so if any selling which you do, so that money which gets generated through that needs to be invested again as per the pattern.
Correct.
So your allocation will get disrupted. So if you do it through ETF, then you can at least because churning at ETF level will not impact your allocation. And similarly, like for example, on debt side also, constant maturity index tracking ETFs, that will help us in taking the duration call. Because if you do the active investment again, whenever you sell, that amount will need to be split as per the allocation rule. So whereas if you buy this constant maturity ETF, then it will help in maintaining the duration as well as reducing the number of transactions at PF level.
Sure. So Manish, if I were to ask you, I mean, people who manage the retirement funds, for them challenging is to maintain the statutory returns. Okay, I'm sure people suffer. I'm sure Mani is nodding his head, so I can fairly understand his heart. What is he talking about beating? But how ETFs have played that role of a problem solver?
So EPFO is declaring a higher return than the, you can say, debt market. Last year they have declared 8.15%, and prior to that they had declared 8.1%.
Yeah.
Presently, SDLs, category 1, if we consider SDLs itself, they are giving 7.7% roughly. And category 2, if you go for good PSU and other category, they are also at par with them. So there is a gap of around 40 basis point. That's to manage if you have to meet to the statutory returns. I remember this last interest rate cycle peaked out around 13-14. So as of now, some trusts, some fund houses are having their high yield securities in the portfolio. Some cushion are coming from there because normally our investment horizon is 10 to 12 years. So some 10, 15, 20 basis point cushion is there. But for rest, certainly we are lying on the ETF. We are booking some profits to meet those returns. Now going forward, it's going to be more challenging because those high return securities are going to vanish from the portfolio in next maybe 1, 2, 3 years. They are already started vanishing.
Correct.
But after 3 years, there is no as such returns. You have only at market securities in your portfolio.
Yeah.
So that gap one must have to look to fill from ETF only. There is no other investment in the prescribed investment list on the EPFO.
No, sure, completely agree with you on that, and I'm very happy to hear that, honestly. So there is no doubt about it. Mani, if I were to move to you, because I'm sure we talked about various products,
Right.
what difference the various products within the ETF category have seen? Maybe a vanilla ETFs, you have seen thematics, you've seen smart beta, etc.
Right.
Which ones are better for your allocation, and is there any reasoning around it?
Sure. So basically market ETFs are those which are tracking the broader indices like Nifty 50, Nifty 100, Nifty 500. Thematic ETFs are those which are tracking certain sectors. For example, banking and financial services ETF that you have, or healthcare ETF one can have. So these are sector ETFs. Besides this sector ETF, there are geographical ETFs also which are looking at, say, China or US or European stocks or certain technology, or even the themes that we just spoke about, mega trends like big data and AI. These are all thematic bucket of ETFs. And the third one is smart beta ETFs that you mentioned.
Yeah.
So these are basically ETFs developed on theories of FEMA and French of factor investing model, which is an expansion of capital asset pricing model. So basis this, they have come up with certain growth versus value, size like small versus large, low vol versus high vol, and basis that these smart beta ETFs have been created. Now, how it kind of plays a role in our portfolio, as I said, the market portfolio has to be broad market based, and majority of the allocation goes into, say, a Nifty 50 or a Nifty Next 50 kind of. And in addition to that, there are rule-based, fundamental rule-based ETFs available, which also becomes a part of the strategic allocation of the market portfolio. Along with that, there is these mega trends which are there for decades. So this becomes automatically a strategic allocation, and hence this become a core portfolio. How we like to, and these are basically strategic allocation, and how we play with the thematics as well as the smart beta is specifically tactical calls that we would like to implement. Okay. So we considering, for example, certain industry, because of, say, government impetus or other development activities, if getting favor, or if it's in limelight, we will try to take allocation through tactical allocation for a year or 6 months or maybe 2 years through this kind of ETFs. An example being, for example, in a high volatile market, if you want to reduce the volatility of your portfolio, you can look at a low vol product. Yeah. Similarly, if the value theme is ripe to be kind of harnessed, you can look at a kind of a value ETF. So these are the way we kind of tactically take a call, but overall we try to stick to market-based portfolio at one end of the spectrum, and the extreme, as I mentioned, these are high-risk alpha-generating portfolio.
Sure. Interesting perspective, because all the ETFs. Shekhar, because I'm sure what Mani is talking about make a lot of sense, but let me ask you other question. Does ETF help you complete the portfolio? That's more important to me. And how does that connect with maybe the markets and market conditions, or it's a default product allocation to you?
Yeah, of course. As I said, ETFs, which gives you, pure exposure to the markets, definitely should form part of the core portfolio. And as a tactical allocation, whether you want to do very specific sector ETFs, whether it is banking or pharma or anything else that you want to do, you can always top up your investments through allocating through these sector funds from the Indian context. As I said earlier, you can look at some of the global ETFs, real thematic ETFs, which you want to take exposure to, whether it is robotics, AI, EV, or some of the commodities which are not available in India. So that definitely helps you create a holistic portfolio, which is forward-looking from a 3, 5, 10-year perspective. And yes, in that sense, definitely ETFs give you that ability to complete the portfolio on an overall basis. So that's one. Adding to what Mani said, a lot of smart beta ETFs are coming up now, and those also, in my opinion, should find place in the core portfolio. Rather than just having pure market exposure. You could do smart beta ETFs, whatever is your style. It could be growth, value, momentum, or anything else, or low vol, whatever you want to do. But definitely these are also very critical from the perspective of core allocations in the portfolio. Yes.
Sure. No, interesting to know that. So, Umesh, if I were to move to you, because we generally talked about a long investing or a decades-long thematics, ETFs, etc. But if one creates a short-term ETF on the debt platforms, maybe, but will that help you in Transact become maybe part of a solution for treasury also, which you manage?
Yeah. So, whenever any new product is suggested, first thing we look at is whether can I do it on myself, and another thing is how much will cost me. While doing it on myself, the challenge is like, for example, if I have to, let's say, sell 1,000 crore of liquid CDs, it will take time and it's not that easy. Whereas I can just sign the redemption letter and give it to you, and next day I will get the money. So if short-term debt ETFs are available at reasonable cost, then definitely it will have a demand. And we also have a selfish interest from issuer side also, because we are one of the largest asset supplier for short term. So if that market grows, then definitely will increase the demand for our papers also.
So NHPC is listening. Yeah, that also is listening, for sure, no doubt. So Mani, if I were to move to you, if you look at the ETF offerings in the market, does that actually create alpha for you?
Yeah, so absolutely. So as I mentioned, the market portfolio is going to give you market return. The alpha that we are trying to generate is through the tactical opportunities and the themes that we are trying to play out. Automatically, when we are looking at, say, this cloud computing, AI and all, anyone who would have allocated probably when we would have, like 2-3 years back, these maybe because of the euphoria or the buzz that is there around the globe, have delivered a supernormal return. But eventually, this will derive a normal CAGR when you hold it for a decade. So definitely, these are much superior return compared to what a normal index would give. Now, a combination of this kind of products with, so that, I mean, on a shorter term, or maybe in 1-2-3 years, you should not underperform the market also at one, I mean, because it's clients' money at the end of the day. And in other, on the other hand, you have to play on this kind of themes as well as this kind of mega trends so that you can draw balance to generate that additional alpha. So to answer your question in short, absolutely it is possible to kind of outperform market using these ETFs.
Wow, that's an interesting thing to hear that. Maniji, if I were to ask you, I'm sure you touched upon retirement fund and the statutory returns. There's a lot of discussion around equity percentage may go up from here, possibly. Maybe we are following the global trends as well. What if it grows from 15%, allows you to do 20 or 25 or whatever it is? Will that help you in generating better returns for a longer period of time?
Yeah. So I said that EPFO has started investment in 15-16. So they have started 15-16. You can imagine what was the Nifty level or index level. It was around 8,000, 9,000 level. So presently they are sitting on a roughly 2 trillion rupees of AUM in ETF and Nifty at all-time high. So you can imagine what kind of money they are sitting on. And on the other hand, so many exempted trusts are not doing investment or they are doing just a 5%. I know some of them are doing just arbitrage investment in the year just to comply with the provisions and then getting out in the early next financial year. So how they going to survive? So my point of view is, first we have to raise the lower limit. So make the mandatory limit to 10% at least.
Sure.
So don't give them an escape route. So they are certainly going to fail in some point of time, or employer has to bear their shortfalls, certainly. So increasing upper limit that they are going to consider. I think last year also they considered the proposal, but due to some US volatility, inflation and all, they deferred it. It is certainly going to come, maybe 15 to 20. But they must increase the lower limit first, or simultaneously they can.
Sure. No, interesting thing to know that. I don't have any further question, but I have something to, a quick fire round, maybe before we summarize the session maybe. Maybe I will not give you more than 10 seconds to answer that as well. Okay, so let me go one by one quickly. Okay, Mani, that's for you. First question coming to you. In the year, which year did you start investing in ETF?
In ETF?
Yep.
2017.
Yep.
18,
don't tell me 15 yet.
18, 19.
Okay, Shekhar.
18, 19.
But why not 2015, 16 when the ETF was allowed?
So that you know PSU or some.
Okay, I get the answer. Okay, so let me go to Shekhar. One ETF product which you love to take exposure in, all the time.
Right now?
Anytime.
Momentum.
Nifty 50.
Nifty 50. I expected that.
I just missed it.
Sorry.
Nifty 50, value 20.
Nifty 50 value. Okay. Interesting to know that. Mani, one sector which is all weather for you to have exposure in on ETF side.
I think banks, Indian banks.
So consumptions.
Okay.
So sectors I use tactically.
Only one, Shekhar. You can't be
Futuristic
diplomatic.
or now?
Now.
Pharma. Banking and financial services.
Banking. Okay. Interesting to know that. One overseas investment, ETF investment which you are actually proud of, which you took.
Actually, it is NASDAQ 100.
NASDAQ 100. No overseas.
NASDAQ.
NASDAQ. No overseas investment. Okay, interesting to know that. I'm sure if you hear them, you found two kinds of people in this. Okay, you found Mr. Manish and Mr. Rathod as the Rahul Dravid, who play safe and keep going and playing. And then you have two Surya Kumar Yadavs also in Money and Shekhar as well. So to encapsulate, I think they found ETF to be an interesting product category for all of us. And I'm sure all of you heard their views on the markets, as well as domestic and global ETFs. I hope you found the conversation interesting and a value for you. Thank you so much, everyone, for listening to this. And thank you, panelists, for your views. Thank you. Can I just have a photograph of this? Just give me a second, Karunya. Mani, can you just hold on for a second? Let's just take a quick picture of a panel. Yeah. 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 Okay. Okay. Yeah. Thank you so much. Thanks, everyone. Thank you.
Guys, I would like you to wait up. We have a token of appreciation, and to give away that token of appreciation, I want to call upon Mr. An, who's the Chief Business Officer at Mirae Asset Investment Manager India, and Mr. Taiwan Kwon, who's the Chief Financial Officer. Guys, please come on stage and hand over the Please give a huge round of applause for our panelists for such an exciting conversation that we just had.
Yeah.
Would you like to pose for a photo op?
Thank you so much. Thank you so much. Thank you so much. Thank you.
Thank you once again. Okay. Change. Please bring your hands together to call upon my next guest. Mr. Sanjeev Mota is the Managing Director, Kanjalochna FinServe, and our moderator for this conversation, Umesh Kumar Dalia, who is the Head ETF Sales, Mirae Asset Investment Managers, India. Come on, guys, show some enthusiasm.
Thank you. So there have been discussions about liquidity, and I'm sure in India we have seen a lot of instances where liquidity is being questioned, and especially in ETF. And I think most of our speakers had one concern, which is about liquidity. And I think to address that thing, we wanted to address that part here. And I'm sure, especially when we talk about in Indian market, when the retail investors, because we have a long way to go to reach to that level where we can see that the participation is huge. For that, the liquidity is something which has to be addressed, and I believe that with time, it has been addressed a bit, and I'm sure it will be addressed with time, because SEBI is also coming out with a lot of regulations, and that will help. At Mirae Asset, when we started our ETF business in India, we wanted to address that part, and we wanted to make sure that investors should get ETFs at the right price, with a better liquidity, with a good order book. And for that, we have a lot of multiple market makers for across all our ETFs. We have our own sister concern, which is Mirae Asset Capital Markets. They have been doing market making for across all our products. So we have been doing it pretty well. And today we have Mr. Sanjeev Mohta with us. He's at the forefront of market making, and you have been doing, I think, since long. So it's good to hear from him how he is being managing it. And I just want to ask you a few questions where I'm sure everybody has in mind that what is going to happen. And more of that, I just want you to talk about more how it happens at the back end, because there are a few myths about liquidity in the market, which I personally think. So with that, I'll ask you a few questions. If you maybe if you can just answer them and you can help us in terms of understanding liquidity more.
Hello. Yeah, sure. Thanks for having me for this event, and congratulations to Mirae for putting so much resources behind popularizing ETF as a product. So it's quite commendable compared to that you are a very new player and they are large biggies, but the focus you are giving to ETF is really commendable. So congratulations to you for that.
Thank you for that. So I'll just ask you the first question to you, Sanjeev, is maybe for the benefit of audience, we can ask, can you explain how do you provide liquidity in ETFs on exchanges around the right prices? So what is that you do and what is the process, if you can explain?
Right. So as you must be aware that ETF is a product which gives you a live NAV. So as a market maker, our endeavor is to provide that live NAV to all the investors. So most of our market making is automated. In fact, the equity ETF market making is all automated. So what we do is we collate the live market prices from the exchange and compute the live NAV, which goes into our automated algos. And the algo then quotes a bid and an offer around that NAV. And we try to make it as fine as possible because it's a function of the costs involved in creation or redemption of the ETFs. So for equity ETFs, there are different set of costs. For a non-equity ETF, there are different set of costs. So bottom line is, we compute the live NAV and we populate an offer and a bid around that NAV so that any investor who wants to buy, my offer is there for him to take, and any investor who wants to sell, my bid is there for him to offer. So it's fairly automated. Fixed income is not automated because we don't get live prices. As most of you must be aware, fixed income is a OTC product. We don't get live price feed. So that is done manually. But even there, we have been successful in giving fine quote on the exchange based on our expertise and experience.
Okay, great. So we have seen that exchange traded funds are kind of product where people want to go for a live NAV, want to capture the NAV movement. And you must be facing situations where a lot of demand is there in the market on the both buy and sell side. So how you manage that situation?
So, ETF is nothing but a wrapper around the underlying basket of securities. And as long as the underlying basket is liquid, we have no challenge in providing liquidity. Because we have the option to create or redeem with the AMC. We have access to the live markets. We have access to the hedging products. So we ensure that any amount of demand or supply we are able to meet as long as the underlying basket is liquid. So, this is a question which I get asked often by, many clients and investors that, if a particular ETF is not having much volume, can you provide large liquidity? So the answer is absolutely yes, because, if the underlying is liquid, I can provide any amount of liquidity on the ETF. That's not a challenge because I always have the underlying market to access and provide that liquidity.
So is it right to say that it doesn't matter or doesn't impact much if there are lesser trades in that particular ETF, if the market maker is there with a quantity, I'm sure.
Absolutely, absolutely. So for us, as I mentioned, ETF is a wrapper over the underlying basket. So whichever ETF we are providing quotes, we have ability to provide any amount of liquidity on the buy side or sell side, as long as I said, underlying should be liquid. And the underlying would be same. So for all Nifty ETF, the underlying is same. For all bank ETF, underlying is same. So underlying market is liquid. That will directly percolate to the ETF market. So there will not be any challenge per se, whether it trades large volume or small volume.
Okay. So actually, recently we have seen SEBI's regulators coming out with some regulations pertaining to market making. So what do you think, Sanjeev, that how these regulations will help and how the market making business can evolve in future in India? What is your take on it?
Yeah, it's a good question. In fact, I was part of the SEBI committee which drafted that regulation. It's a very innovative regulation which has been accepted by SEBI, which will reduce the capital intensity of market making activity. So today, market making is very capital intensive. As market maker, I have to deploy a lot of my capital. And that capital cost gets built into the pricing spread, which I quote. So the moment the capital intensity reduces, the cost of capital which gets added to my spread will get reduced. So it will eventually lead to finer spreads on the exchange, on ETFs.
So you're saying that if regulations are in line and everything goes as per plan, so the capital required by a market maker, the requirement can go down significantly, and which which will at the end help more people to get attracted towards this business, maybe
absolutely,
more.
Absolutely.
As Evan mentioned that in Australia there are 3 key market makers, and we are lacking that space here in India. So that might help.
Absolutely, that will help the ecosystem in a big way. If at all capital is an entry barrier today, that will go away. So it will bring more market makers, and even the existing market makers, they will be able to reduce the spread.
Great. So at the end, I just want to ask you the last question is that, so if somebody, any investor, be it a retail investor or an institutional investor, wants to buy or sell, say, some quantity, desired quantity, so what will be your tips to that person, that investor? What things he should be keeping in mind while buying and selling so that he get a desired quantity at the right price with a minimal spread, and there is no impact cost also? So if you can add that.
So I think, any investor investing into ETF should always look at the live NAV, because, unlike a stock where the price is homogeneous, here the NAV for Nifty ETF also will vary because of the vintage. So a ETF which was launched 10 years back would have a lot of accumulated dividends, and the NAV will be higher than the like-to-like Nifty levels. So it's always best to look at the real-time NAV and then see at what price the ETF is being offered. And many a time you will find that you might be able to get at a discount to NAV because there is a bid-ask spread. So if, as an investor, your trade is not time sensitive, you might place on the bid side lower than NAV, you might get hit there. So that is something which can help. If it's a time sensitive trade, you don't want to wait for it. But if it's not a time sensitive trade, you can put a bid which is lower than NAV, you might get it better than the NAV price also.
So so I think if I had to conclude it is like you're saying that if a market maker is strong enough, having a decent quantity in their books, or if the new regulation comes in, then obviously that requirement might not be needed, and then market maker can provide more liquidity. So it's purely a game of market maker when it comes to liquidity, right? And I hope the way you explain, I think these are the processes which I'm sure most of us are not aware of, how the liquidity is being managed, and how when we say this particular ETF is fairly liquid, we generally look at the trades. But that's not the right way of looking at it. The right way of looking at it is what sort of order book is there, and if the market maker is standing there or not. If that is there and efficiency is there, I'm sure the liquidity challenge can be addressed to a certain extent. So I think thanks for that. I think these kind of insights, this will help, I'm sure, and I believe that the new regulations will help in terms of evolving this particular space. So thank you
Yeah, I
so much
also
for that.
hope so. Thanks for having me.
For your time. Yeah, thanks. Over to you, Karunya.
Umesh requests you to give away a token of appreciation to our guest, please.
Okay. You okay?
So, can I have Mr. Ryan Kim, CFO of Mirae Asset Capital Markets, India? Can I come here and do the honors? Thank you so much.
Thank you so much, gentlemen. Okay, so we finally reached the last leg of our conclave today, but it's last, definitely not the least. How will the usage of passive evolve in our client portfolios? How will the product landscape shape up? What exactly lies ahead when we talk about the future of passive, not just in India, but across the world as well? And that's what we're going to address in our next panel discussion. Please join me in welcoming on stage Nitin Verma, the Chief Executive Officer, Mirae Asset Global Indices, Rupali Prabhu, CIO, Head of Products and Solutions, Sanctum Wealth Management, Evan Metcalf, Chief Executive Officer, Global X Australia, and Shantanu Bhargav, who's the Head of Investment at Waterfield Advisors. And our moderator for the session is Siddharth Srivastav, Head ETF Products and Fund Manager, Mirae Asset Investment Managers, India.
Hello. So we had multiple sessions which spoke about how the usage of ETF is evolving, what sort of product landscape we have, how much growth we have seen in AUM, in ETFs, in index funds, and we also talked about Australia, right? And possibly we have a lot of learnings which we can take from there. And then just in the last session, the most important aspect on how market making is done in ETFs. So I think the last session, it's actually perhaps pertinent to talk about what future holds for passive. In India, we have 380 ETFs and index funds, and out of which 51 are smart beta products. 64 are sectoral and thematic products. But if you look at AUM distribution, which multiple speakers have spoken about, 54% AUM in passive is in Nifty 50 and Sensex products. 24 is in target maturity ETF, so that accumulates to almost 80%. So while we have a lot of products, especially on the strategy side, on the theme side, on the sector side, you still see a lot of allocation happening on simple plain vanilla Nifty 50, Sensex, and target maturity ETF. So in this panel, I'll be asking questions on how this usage will evolve and what sort of product innovation we may see in India in future. So my first question is to you, Rupali and Shantanu, is that, as I mentioned, right, in India, it's still about core investing when it comes to when it comes to passive. So how do you see client usage evolving in India when it comes to passive products?
Sure. So, I'm not going to talk about the mainstream funds because there is obvious usage. The rest of the universe, and I'm going to take a little bit of time to sort of share my thoughts. The rest of the universe can be considered in different categories. Let's say thematic, right? Even today, when we think about themes which are long-term themes, let's say, for example, manufacturing and housing, the first go-to in terms of evaluations continues to be active funds. And that mindset is shifting, although a little slowly. But as time progresses, we'll see that in the evaluation in terms of what is your preferred route to market, there will be a debate on whether we should address this by means of using a passive fund or an active manager. And one of the reasons why it is not such an integral part right now is we've seen the markets are still nascent. ETF as a product is relatively nascent from a non-mainstream perspective. So we've seen that it's only after a fair amount of interest comes in a particular theme or a sector, or even in case of international thematic, is when ETFs get launched, right? So a fair amount of run-up is already done, and a lot of us are circumspect in terms of how much more steam does it have to go. But once it is launched, it is there, right? So in future, whenever we need something to address, that's something that one would consider. So that's a little about thematic funds. Sectoral is, sectoral funds and the usage of sectoral funds is going to be a little bit restricted till indices themselves are better constructed. When we look at pharma or when we look at auto, top 3 stocks are 50% weight in the index. So there are times when your passive managers will do extremely well because those are literally the 4 stocks running. And then there are times where the active managers will hugely outperform some of these sectoral indices. So sectoral indices is a little more tactical in nature. And then you have commodities where, unfortunately, at this point in time, they were a very important way of accessing the markets, but the tax setback is something that people do need to consider in their allocation. And finally, we come to international. Now, international, and again, we don't want to talk about S&P and NASDAQ. It's very commonly owned, which is what the AUM also shows. But I think we need to evangelize a lot in terms of how you can use these. We talk about mega trends, but in any mega trend, you have, even within mega trends, you have smaller cycles, right? And investors, and I can only talk about my segment, which is the HNI and the ultra HNI segment, that even if they have intergenerational money, the product evaluation happens at every 3-year cycle, right? So, and we have to contend with reality rather than being idealistic. So the point is, even if you're bought into the mega trend, to determine whether this is the right valuation to enter into or not needs a lot more studying, needs a lot more evangelizing with investors as well. So all of this is relevant. We just are beginning to put in effort to understand positioning within our own portfolios, and as time progresses, this is how I expect the usage to evolve. And all of this is within core and tactical. And the one segment that I didn't talk about yet is the smart beta funds. Again, within smart beta, you have multi-factor funds which can be a little bit more evergreen, so potentially can become a part of core portfolios. Single factor funds, just momentum or just value or the likes of just quality, needs a lot more timing element, right? Or you have to be with that for ultra long cycles. So more multi-factor funds, I would assume, as we evolve this space, will become a part of core portfolios, if we look into the future.
That was very detailed answer. Very interesting to hear that you're already talking about multi-factor, whereas I think single factor or a product is something which is picking up. Multi-factor, yes, we hope that market pick that up very soon. Shanu, you want to add your point of view?
So I'll just add a few points. So it's interesting that you mentioned the point, you started with the term core. So I believe when it comes to core allocation in a portfolio, so core is all about stability and long-term investing, and it's the foundation, forms the foundation of a portfolio. So using narrow sector-focused indices like, let's say, Nifty Bank, etc., in congruence with, let's say, the core part of the portfolios, I feel it's not correct. Bank or any sector-focused ETF, they don't offer clients a very broad-based diversification, which is a core tenet of any core allocation. So as far as core allocation is concerned, I feel and believe that broad-based, low-cost, market cap weighted, simple, traditional ETFs will continue to form a core of the portfolio. So that's one, and as far as core is concerned. Now, when it comes to usage, there are two trends. So one is that what do we see prospectively? Prospectively, we can always look westwards because we are heading in that direction. So in US, we have got more than 2,000 ETFs. And only 32% of those ETFs are in traditional funds, remaining 68 are narrow sector-focused smart beta funds. So what we feel is that there will be proliferation of a lot of narrow sector-focused and factor-based ETFs. What that will lead to, now I'll talk about usage in two contexts. So I'll come to my segment, but before I come to my segment, I think when it comes to retail segment, in the case of retail segment, it can be a double-edged sword because as you know, the retail investors are prone to performance chasing. Now, smart beta indices, there are very few that are driven by multiple factors. They are based on one or two factors. And if you look at last 3 years, for instance, if you look at Nifty's smart beta indices, out of 12 large cap oriented factor based indices, 11 have underperformed Nifty. So they're prone to cyclicality. So what we envisage is in the case of retail investors, they will get interested in these factor based ETFs that will at the outset promise outperformance. That will be their calling card, but they will enter into these ETFs at the wrong time, And then eventually, as it always happens, reversion to mean will happen and they will exit at the wrong time. So there will be a gap between their returns and the ETF returns. Now coming to my segment, so in my segment when it comes to family offices, time doesn't help us as advisors. They have a lot of time and sitting still and not doing anything is something they don't like doing. So if there is lack of activity, it's something that they're absolutely averse to. So what happens is in our segment, they're always on the lookout for a performance edge, an idea or a vehicle that will end up delivering market-beating returns. So in our segment, for sure, more complex products that you take to them, more excited they are because they associate complexity with potential for market-beating returns. So for sure, they will be interested in smart beta products. So I'm sure they'll dabble into it. And they're not too far off when it comes to behavior. So if they don't get the entry right, even their experience will be subpar. So that's how usage will evolve, is what I envisage as we go forward.
So as per you, simple is the best solution.
Absolutely.
And if you are doing exotic, you better time it right.
No, so see, the thing is, just to add to it, I think complicated smart beta strategies or factor-based strategies are like precision tools. Now, precision tools are good in the hands of people who know how to use them. They can create something fabulous with them. But they can be very dangerous in the hands of people. It can be self-destructive. Now, that's where the challenge lies. So unless you have a framework where one can be counterintuitive. For instance, last 3 years we've seen this reversion from growth to value. Now, I don't know how many investors proactively entered that trend. Almost everybody is now talking about value, after value is done well. So that's where the core challenge is.
No, absolutely, very well answered. So now I'll move towards a person who handles or creates these precision tools, the index guy. So Nitin, can you tell us what sort of product innovations you are seeing happen globally, and what sort of trend do you see in India currently and from a future point of view?
After hearing all these sessions, frankly, I am also enlightened a little, right? Coming from an index background, what we see globally happening is, as Evan also pointed out in the beginning phases, right? There's a very high stress on income strategies, fixed income indices, and to some extent what has been missing that I couldn't see in any of the presentations is an inclination towards ESG indices, not ESG per se, but more aligned towards the climate transition side of it, right? So climate aligned indices is something which is gaining a lot of traction, especially in the European markets. And you will see a lot of the other two, the fixed income indices or the income indices, is like everywhere around the world. Everyone is working on it. I mean, correct me if I'm wrong, Evan, but that's my take on it, right? Now coming to the Indian markets, broad-based indices are there to stay. I totally agree, nobody can do away with it. However, the way we see thematic indices is a little different than what it is perceived outside India. We see thematic indices as something like a finance or a biopharma or a pharmaceutical. However, there's a slight change in the way the themes are defined, especially with the advent of Global X. If you see, there are a lot of disruptive themes in the market. Just before this, Sanjay had that session wherein people were talking about like AI, big data, fintech, cloud computing, electrical vehicles, battery technologies, and things like those. Those are the themes which are going to evolve. These are not yet there. I agree, there should be a lot of awareness that needs to be first created around the timing of the market, and we need to give them the right set of tools. But yes, having that set of tools in their hands, I think these are the thematic indices is something which is very upcoming and has got a very good potential for the future in India. Obviously, the broad-based indices are going to stay. That's not going anywhere. And the factor indices, obviously the plain vanilla factor indices is something which is very prevalent. Everybody invests in it. So it is, again, it's a good to have. But then I think we need to tweak around a bit. Just a single factor index will not help. We need to have a multi-factor index, either a multi-factor index, or we add value or a growth or a quality factor along with some other factor like fundamental factors assigned to it to achieve at a desired portfolio, which can give us the competitive advantage. That's what I would say.
So I was having discussion with Nitin before this event, and he was going on and on about income-based products that in US and in other geographies, covered calls are doing really well through ETF route. You can launch buffer ETFs, etc. We all get excited, but in Indian regulation, unfortunately, we cannot launch those strategies in ETFs. So Nitin always have very fancy ideas to talk about, especially on the income strategy and derivative side. But we hope very soon Nitin will be able to come out with those products. But I agree with what the panel has said till now, that as we are launching more exotic products, it's also important to understand the cyclicality associated with it and nuances which they bring. They target a very certain risk and return profile, and that is what investors should note before investing. So thank you, Nitin, for that. Evan, I think you gave a very insightful presentation on growth and current trends in Australian market. So other three have talked about products. So apart from products, what do you see in terms of evolution happening in passive domain in Australian and global markets?
Yeah, I think you're right. I think we've covered a fair bit of the spectrum around actual product innovation, around some of the income strategies, and I'm sure there's many more exciting things to come for the Indian market in that respect, and I see sort of evolving regulation and different types of products being allowed over time, and that's quite exciting. I think the one kind of, I guess, interesting point from, just to sort of follow on from what Nitin was saying, is just around, I think, more the sophistication of the underlying indices. So people tend to think about passive investing as being somewhat simplistic and being rules-based, and that's kind of like an easy way. So if you think about the active versus passive debate, there's a lot of analysis and a lot of complex work going on behind the scenes with an active fund, but with a passive fund, whether it's a thematic or a smart beta or just a plain vanilla, that seems to be a more of a simplistic setup. But I think really the actual evolution of some of the behind the scenes things that the index providers do in making sure that an index can actually represent effectively a real world scenario is really important. So you see things like constraints on index turnover, different constraints around sector allocations, around country allocations and things like that, so that you don't want to have the situation where you have unintended consequences around index investing, because that's really not going to be helpful to investors in many ways around their sort of confidence in how these strategies work. So I think there's a lot of value add that index providers actually have around how they design the indices, a lot of detail in the nuances that many investors wouldn't necessarily be aware of, and I think that's a really evolving space as well.
Thank you, Evan. Shantanu, so you talked about in terms of various product segments, but I want you to be more specific in terms of which product segment do you think will gain more traction in next 3 to 5 years, apart from the usual culprits, Nifty 50 and Sensex, and how do you think that you can add passive in your client's portfolio in coming years?
Sure. I'll answer that in two parts. So first is, I feel there's a growing realization, so investors are smart, and they understand that high cost saps the performance of the overall portfolio, and it even saps the performance of some of the most skillful active managers. So investors are smart. So what I firmly feel is that as investors realize more and more that there's lack of persistence in the case of outperformance of active managers, and they also realize as time goes by, and we've already seen it in the last 3 years, that markets become more efficient. So these two trends will actually drive this movement from the active bucket to the passive bucket. And in the passive bucket, I think by virtue of its simplicity, low cost, most importantly, again I feel that traditional index funds or ETFs will be the biggest beneficiaries of growth in the next 3 to 5 years. It's going to be very difficult for them to understand the complexity around. So for instance, very recently a quant fund was launched by one of the AMCs. It took us a day to understand what it was all about. It was it's a cocktail of multiple factors, and we were not able to decode what is going to drive what. So in terms of product categories, for sure, when we look at next 3 to 5 years, traditional, simple, low cost, diversified, market cap weighted, basic index funds and ETFs will be the beneficiary of this migration from active to passive. And obviously it helps when you have the EPFO money going there, the NPS money going there, a lot of institutional money is also going there, and there's performance evidence to show for. Smart beta is going to be hot for sure, because the lure there is that the pricing is in between active funds and passive funds, and with lower cost, one can expect market beating performance. So I for sure see smart beta doing well, but obviously I've already spoken about what could go wrong there. In terms of integrating passive strategies in our portfolio, the way we like to think about it at Waterfield is that generally in the marketplace what happens is people move straight from asset allocation to managers. What we think about is that for under each asset class, what is the most optimal way to populate the sub-asset class. So let's say if a client is given us a mandate to build a 50 large cap, 50 mid cap portfolio. So if we think about the best way to populate that large cap and mid cap portfolio, it will automatically take us to the right managers. So again, going back to the point on efficiency, large cap space, the top 120 stocks are so heavily analyzed and tracked. There's very little competitive advantage. I don't know if active managers are sitting here, don't mind this, but there's very little competitive advantage left for any active manager in the large cap space to have a sustainable advantage to deliver consistent alpha. So we are preferring basic large cap oriented strategies as the core of the large cap portfolio, and around that we have some satellite allocations. So out there we may look at, let's say, an equi-weighted index or some one or two other factors. Conversely, on the mid cap side and the small cap side, we feel that there's enough inefficiency. There is reward for hardworking managers to actually go to the companies, talk to management, competition, and come back with information that can be used for generating alpha. So on the mid cap side, in our framework, we have very little allocation to passives at this point in time, and bulk of it goes to very high quality bottom up mid cap active managers. So this is the way we approach. And lastly, when it comes to very narrowly defined ETFs, we use it thematically. So let's say in an overall portfolio, if we have to express conviction tactically, let's say a particular sector is going through a bad patch and there is dislocation in valuations, and if we want to build conviction there, let's say IT or banking, whichever sector, then tactically we will use one of the narrowly defined ETFs. That's how we approach the entire construction process.
Thank you, Shantanu. Rupali, your view on this?
So not much different than what Shantanu has said, but that, I think mainstream indices or basically market cap weighted indices is, expected to become a larger part of the portfolios. Partially because it is getting harder and harder for active managers to outperform indices. Some of it is structural, some of it is circumstantial, but the other bit is I'm just going to build a little bit on the smart beta funds that Shantanu talked about. See, today if you want to participate in momentum, either you choose stocks or you don't participate. You don't really have an alternative to that segment if you want to play it tactically. So the single factor funds, have several times, even for that matter, value, right? Or you have so many value funds, but not a lot of active managers tend to exit when it stops being a value stock. They sort of continue and ride the wave. So when you want those accents in your portfolio, we think increasingly people will start looking at this, these single factor funds. From our perspective, I think when we look at, we in fact discontinued research of large cap active funds in 2018 after the SEBI reclassification. We took a strategic call that we see margin of outperformance going a bit, published a note as well. So we've sort of crossed that a long time ago. But we do think that if you want to play large cap, you have options like something like an alpha low volatility, which is a combination that generally has done better in most kinds of market, right? It never is shooting the daylights in terms of returns, but it doesn't give you big drawdowns either. So, strategies like that can be part of longer term core portfolios in our opinion, and that is how we, really look at it. But nothing really to beat the role of the mainstream indices. And then the other things I've already talked about, so, the tactical accents, etc.
Thank you for that, Rupali. So Nitin, Shantanu spoke about that he took almost 1 day to understand how quant worked in one of the fund. And actually my next question was regarding that only, because are indices becoming too intelligent or too complicated? Because we are now seeing natural language processing, probably AI coming into play in order to pick and drop stocks. So what is your view? Are we tweaking or making them more intelligent, or is it good or is it bad?
Yes, with the advent of the next big innovation in terms of indices as a domain is going to be artificial intelligence, like you rightly said. And yes, it is going to make pretty difficult to convince anybody why you pick A vis-a-vis B, right? But then, frankly, the AI algorithms that are there as of date, like an NLP algorithm, right? It's like a general English format. You are reading English words to figure out a sentiment from it for a specific stock. I mean, it is a little counterintuitive, I would say, but then when you go through that text and try to comprehend it as a person, you will arrive at the exact same conclusion. The only benefit that you get is you don't need to parse through like hundreds and 500s of pages to arrive at a conclusion, which can be done like in a jiffy. So yes, AI is going to be a big time innovator for indices as a domain per se. And then we are talking about a bridge between active and passive, right? So the second biggest innovation that is going to come in is in the form of direct indexing. What basically direct indexing would entail is it would give people like you guys the advantage of picking a benchmark, whatever you want, be it Sensex, be it Nifty, be it S&P 500. Select the stocks that you want to do, reweigh as and how your customer wants, right? So essentially what is happening is you customize a portfolio based on the risk appetite and the interest of the consumers. And you do it at a retail level. That's going to be the next big innovation in terms of indices. And that is just around the corner.
Fine.
Yeah,
Let me just add. I'll just like to qualify my comment. So basically, complexity in our world is okay. So our clients have the luxury of good advice. We can help them comprehend and demystify products. But overall, when you're democratizing the whole thing, that's where it's a test of character of the entire financial intermediary space. Because how are they going to take across these ideas and explain to their clients? Because bulk of the market still operates under distribution, and the primary decision making there is based on past returns. So that's where the challenge lies, that how we can simplify some of these complex strategies. Also, when I think about robo-advisory, their algos are also picking funds based on past performance. It's not very different. So that's where the bigger challenge is. In our case, clients have the luxury of having good advice, and we can decode stuff for them. It's not a challenge there. It's more with retail, because you're taking a mutual fund is a retail product and you're taking it across to so many investors. So that's where their initial experience will determine whether they make friends with the category or not. So imagine if someone is coming into passives for the first time and gets into a complex strategy, burns their fingers, they may just kiss goodbye to passives as a composite. So it's also important to think about their experience, that how they're initiated in passives.
No, absolutely. I completely agree with that. I'm like, when we launched FANG Plus, that's a high risk, high reward sort of product, and we saw a lot of investors who were investing for the first time in passive space through that product. And obviously, the question arises that what sort of experience and journey they will have with that product. Even you also have now, apart from those very complicated indices based on NLPs, AIs, etc., also active ETFs, right? In one of your slides, you were comparing actually passive ETFs versus active ETFs. So what is your feeling about making underlying so intelligent that it may be for the good also and possibly for the bad also if investor is not able to understand what he or she is getting into?
Interesting question. I think there's room for choice. I think that's really the key element of the ETF market all up. There's choice around how complicated you want to be. There's choice. It's a product that is retail friendly, it's advisor friendly, it's institution friendly. So the market, as the market evolves, you're going to see participants from all spectrums of the market involved, and that's going to mean that all different types of products are applicable. I mentioned as you said, the active ETF case in Australia. That seems to be getting stronger and stronger. We had JP Morgan come into our market late last year. We've had, just in the last 3 weeks, we've had Dimensional launching funds. We've had Macquarie launching active funds as well. So there's a lot of evolution happening there, and they're launching their flagship active products as ETFs. So I think it really comes back to that, okay, ETFs are just a wrapper. What goes into the underlying investment, how complicated it is really down to the individual product issuer, who their target market is, ensuring, that's probably the other interesting area in Australia that we've had from a regulator point of view in the last 2 or 3 years, is really defining who the target market is for a particular product, and ensuring that you actually get your distribution model right. So you don't want to be pushing those super complicated funds to retail investors who may not understand them. That's very much, I guess, the trend on our side at the moment is really just trying to get as much product into the market as possible, but trying to also make sure that that product ends up in the right hands. So yeah, I think there is room for a lot of different things. I think there's room for AI. I think that's a really fascinating, it is sort of that bridge between active and passive. I think there's definitely, we're going to see a lot more in that space. And yeah, I think that there's, it's a wrapper effectively, an ETF, so you can put anything in there in some ways.
So I think this will be my last question, and just adding on to what Nitin and Evan said, that there are so many exotic things happening globally, and you both have briefly touched upon that, right? When you spoke about smart beta being cyclical and investors needing to understand what sort of complexity and benefits or drawbacks they bring to your portfolio. So I think this is a sort of two parts. First of all, which exotic product which is available internationally do you want to be present in India also? It can be anything, right from active ETF or income strategy, anything. And then what is your view on this entire passive space becoming more and more exotic, at least from an option point of view? AUM, as I agree with you that it will remain on the plain vanilla side, but at least as an option. What is your view on that? And then Shantanu, in the end, you can add to what Rupali has said.
So, when we were younger, for most retail investors, the go-to savings instrument was fixed deposits, and mutual funds were too complex. And then, people did miss time, short duration, all of that. And then through that pain, we evolved. We found the, magic letters SIP, and you've seen retail interest. Today, on the back of retail interest, the domestic purchases are basically, the domestic flows are ahead of FII flows. So every part of innovation takes some time to mature. And till such time that it has not attained that level of maturity, there is information asymmetry around it. And that information asymmetry very often is a source to generate alpha in client portfolios. So we absolutely welcome innovation in all kinds of products. What we need to be careful about is we need to understand, and when I say we, I'm not a representative of retail investors at this point in time, right? So we deal with some of the savvier investors and the savvier segments. So we need to be careful as advisors or as distributors that we position it correctly and we explain the risks correctly, right? Momentum is not the panacea of all ills. Similarly, when you have AI and robotics and all of that, mega trends, like I mentioned earlier, they do go through cycles. And so anything that is innovative, and by the way, just on the earlier point of democratizing some of these things, it may be complex, but it doesn't mean it is not relevant to retail portfolios either, right? If the back end is complex, but from a retail perspective, it gives it a more evergreen nature, and there is performance, then it'll attract more assets. And what's so wrong with that? Whether the product is simple or complex, performance attracts flows. So just because it's complex, let's not beat it down. So we welcome all kinds of innovation. We just need to make sure that when we say we, now I'm collectively taking the responsibility, we as advisors, you as manufacturers, we position it correctly and we do enough work around helping people understand. So, and until that maturity is attained, we will go through cycles of pain. That's a part of evolution.
Shantanu, your view?
So, I'm sure that a lot of these innovative, complex strategies will be value accretive. And I'm sure your backtests will reveal that, your backtests will certainly show that these complex strategies beat markets. That's what investors are looking for. I think the core issue is behavioral. The challenge is that, and there's so many academic studies, nobody likes to be called an average investor, but I'm just saying, an average investor, their direct equity returns and even mutual fund returns, they trail the markets by around 200 basis points. And almost all of it is attributed to behavior, because they are great instruments. But then when they're bought and when they're sold, and whether they persist with those instruments, determine whether there is congruence between what that great product produces in terms of returns and what the investor makes. Because there's a proverbial gap between investor returns and the product returns. So, and as far as innovation is concerned, it's good. There is no issue with that. But what can be a source of discomfort is that let's go back to the let's take a step back and think about how the journey started. When the first index fund was created by Mr. John Bogle, index funds are a remedy for everything, even world peace. So he launched that in 1976. So there were some key attributes, and one of the key attributes was low cost. Because the belief was that you need to harness the total market returns and pass on those returns to investors and invest for the long term. So one of the things that we need to watch out for in terms of innovation is, and that's something that we evaluate, that these innovative products also need to be available at fair cost. Because if the cost leakage is higher, you're taking away one of the key attractions of passive investing. So that's one more thing. So innovation is welcome, but I'm confident about the way we approach this. We have the framework. So I'll give you an example. My team has a framework of overweighting and underweighting, let's say large cap, mid cap. It's a valuation based framework. I'm not sure everybody in the marketplace thinks like that. So it worries me when I read in the newspaper that fund managers have said that now mid caps are expensive and large caps are good. I don't know how investors react to that. Do they sell the entire mid cap allocation by large caps, or they trim it? Just the way we do. We overweight. We do it in moderation. So with complexity, you also need the right kind of intermediation to ensure that there is lack of gap between the product returns and the investor returns. Lastly, what do we want? We like simplicity. Simplicity beats complexity all the time. So what I desire is that there are a lot of price wars between manufacturers, and the cost of ETFs, they reduce, that will benefit us. In addition to that, to improve the diversification of the portfolio, now we have the gift city route also. At times we've found that there are lack of options available to diversify internationally aside US markets. So that's one area, and as we progress, I'm sure there'll be, now we have a REIT and InvIT benchmark. As that market deepens, it'll be nice to have a ETF that captures the performance of that benchmark. So that's my wish list. But primarily amongst them is a massive price war where all of you create same types of products and are fighting on the basis of cost, so that we all benefit. That's on my wish list.
Great.
Just,
so I'm
just to say that another reason why the advent of AI is going to make it really interesting for you guys, because it's going to bring down that cost.
Yeah, so great. So I think we all agree that both complex as well as simple products are way to go. Simple will gather assets, but complex will find utility in a lot of clients' portfolio as long as they are aware of what sort of risk and opportunities they are bringing in. I think we had from Shantanu's and Rupali's answers, I can see that smart beta, single and multiple factors, are interesting space, though obviously be conscious about the risk. And Nitin was, and Evan also was talking more about AI and NLP based products and active ETFs, which are finding a lot of ground in global markets. We hope that in India also they are allowed soon. So thank you for that, Shantanu, Rupali, Evan and Nitin. That I think all the answers were very insightful. So thank you, and with that I conclude this panel. It's over to you, Karunya.
Thank you, guys. I want to call upon Patrick Lee, who's the Director, Head of Business Management Division, a global business unit at Mirae Asset Investment Managers India, to give away the token of appreciation to all our guests. This is an order of Please give a round of applause, not just to our speakers, but also to all of you who's been a wonderful audience tonight. Thank you so much, guys. But before we let you all go, I want to call upon Umesh Kumar Dela, Head of ETF Sales at Mirae Asset Investment Managers India, to give a small vote of thanks for all of you for being a wonderful audience tonight.
So good evening, everyone. So now I am going to do something which I'm sure most of you must be waiting. So thank you so much for, it's my honor to give a vote of thanks on behalf of Mirae Asset. I would like to thank all of you, all our guests, all our audience, be it online, offline, everybody, for being a part of this event and having a lovely evening in terms of deliberation of a lot of topics, starting from ETF landscape in India to combination of ETFs for clients' portfolio, and then to what is the future looks like, where we can see the passive or ETF can go a long way from here. So I believe this evening, these sessions would have helped you, all of you. I would like to thank Mr. Evan Metcalf, Mr. Mukesh Agarwal, Mr. Umang Papneja, Mr. Vijay Chandok, Mr. Pradeep Dokania, Mr. Manish Shankar Mandal, Mr. Manish Dhawan, Mr. Umesh Rathod, and Mr. Shankar Jadhav, and at their Mr. Sanjeev Mohta, Mr. Nitin Varma, Ms. Rupali Prabhu, again Mr. Evan, and Mr. Shantanu Bhargav to give us the opportunity to discuss about ideas, thoughts, and thank you so much for giving us your time. So with that, I would like to thank all of you again, and I would like to mention at the last thing that we have created something on basics of ETF, how easy is to invest into ETFs. We have created some campaigns, so while you will be enjoying your dinner and cocktail, we will be running the TV. Please enjoy that. Thank you so much, all of you, once again, for taking out time and coming here all the way from long distances, I'm sure. So thank you once again, and I open the forum for dinner and cocktail. Thank you so much. Enjoy.
And finally, the three sweet words which everyone wanted to hear: dinner is served. But for all the viewers who've been watching us online all this while and participated in our quiz, please stay tuned on our Mirae Asset Twitter handle. We will be announcing the winners not tonight, but tomorrow morning. So keep your eyes out for your name and to know who the other winners are for that very, very attractive voucher. Thank you, everyone, and have a good evening.